And here are your top stories. Asian stocks climb and futures point to higher openings. In Europe and on Wall Street, Treasury yields tick lower across the curve, while Bitcoin tops $30,000 for the first time since June. President Biden travels to Ireland to mark the 25th anniversary of the Good Friday Agreement, but talks with allies, including Rishi Sunak, could be overshadowed by a mounting intelligence crisis. Plus, China consumer and producer inflation show ongoing softness in March, bolstering the case for further stimulus. Let's check in on these markets then, and with the context that you saw just about gains eking out at the end of the session in Wall Street yesterday and across the Asian markets, the Nikkei outperforming, the Kospi as well doing fairly well, and modest picture across the Chinese markets, despite the fact that inflation came in softer, again opening the taps potentially for additional stimulus and support from the authorities in Beijing. Here's how things are shaping up then. The futures were pointing positively for European stocks, and the picture now across the Spanish IBEX gains 48 points, 0.5%. Here in the UK, the FTSE 100 gaining 0.4%. We talked about the inflation picture, of course, and whether or not the data, the CPI that comes out on Wednesday, is going to change the calculus for the Federal Reserve. Of course, the markets are now pricing in and expecting a 25 basis point hike come May, and the expectation that maybe that could be the final from the Fed. They're currently across the FTSE 100 gains of 50 points now. Over in France, the CAC up 0.8%. Let's switch it over and see how things are playing out cross-asset. We did have, of course, softer dollar, but also the comments coming through from Ueda in his first public comments since taking over the role at the BOJ. You saw some softness coming through from the BOJ. That is reversed to some extent. Futures in the US pointed to gains of 0.1%. Euro dollar out 108 and 341 on the benchmark 10-year. As we look ahead again to the CPI print out of the US on Wednesday, and then the earnings season kicking off on Friday with the banks, the likes of JP Morgan, Wells Fargo, and Citi as well. To what extent are we going to see margin pressure across corporates in this first quarter of earnings? And is that going to be more significant, arguably, for investors than inflation? That is a debate that continues. Now, traders are looking ahead, of course, to the US CPI report out tomorrow. Economists forecasts a 0.4% increase in the core consumer price index for the month of March. This is markets, as I mentioned, pricing a stronger likelihood of a 25 basis point Fed hike. In terms of the broad line, the top line of CPI, expectations then of 5.1% in March, so down from 6% that we saw in February. Those are the estimates. Let's bring in JP Morgan Private Bank's EMEA Head of Investment Strategy, Grace Peters. Grace, what is more important then for you and the investor community? Is it the inflation print out Wednesday or the start of the Q1 earnings come Friday?
Well, morning, Tom, and obviously it's both to a certain extent, but I think that the inflation print is going to be very important. We've got several Fed meetings coming up, May, June, July, and I think we have to consider that every single one of those meetings is in play. The Fed are going to be data dependent. Now, in our mind, we're going to get 25 basis points in May, and that will be the last hike, but I think it's very important for the market not to get complacent about that. Now, the recent data that we've seen, the ISM, when we look at the jobs numbers and consumer inflation expectations that we got out at the end of last week, all of that indicates that we are seeing the resilience that we saw in January and February fading, but it's still a resilient economy that arguably can take another rate hike.
And strategists at Bank of America saying you want to sell the last cut from the Fed because of the inflation dynamics. They think there's further downside, or at least that these equity markets are going to face pressure because of the recessionary risks. Do you challenge that view?
No, I think the debate after we sort of settle is this the last cut or the last hike or not is going to be how many cuts ensue, and we've got 2 cuts penciled in for the end of this year, and all of that in totality points to a picture of weakening economic growth, which feeds into corporate profits, as you mentioned, but ultimately a more supportive rate environment when it comes to the valuation side of the equity debate. We do feel that particularly US equities are looking a little extended here. Our year-end price target is 42.50 for the S&P, so we're in a couple of percent of that now. So we have been looking more at hedges, rotating into international markets, or selling parts of the market that have done particularly well off the back of this market pricing down of future rate hikes, and that would be technology or high growth sectors.
So you'd be selling technology and high growth at this point. Is that a margins question? There's some estimates coming through that maybe you could see profits falling by about 6.8% versus the first quarter of last year. Is that in line with your view? Where do you see that margin vulnerability?
Yes, I think when we come to earnings in aggregate, the story of weakening growth absolutely applies to corporate profits. We saw for the S&P for the fourth quarter, EPS in total down about 1%. We think it'll be down about 7% for the first quarter when we get through that, starting, as you say, later this week. And the key driver there is margins. Now, the opportunity for companies is therefore to positively surprise on margins through cost cutting. In part that leads back to the labour market, where we're starting to see some weakening, perhaps through investing in automation, which we think is a key theme amid tight labour markets. And so I think if companies can positively surprise on margins, that's probably where I'd expect potential good news to come out of earnings season. And the bad news side of that would be the demand environment, and particularly order books.
And what is the narrowness of the rally that we've seen? 20 stocks in the S&P accounting for about 90% of the year-to-date gains.
Yes.
To what extent is that a concern? Do you expect to see further breadth across these equity markets as we head into the end of the year?
Yes, I think breadth would be healthy. Breadth is healthy, and we've seen more breadth than Europe. As you say, within the US, the tech sector, the FANG stocks really have led that rally, which is why I think it's right to be clipping some of those. But in Europe, where obviously technology is a much lower weighting to the index overall, Europe has outperformed the US year to date in local currency and dollars, indicating that there is more breadth to the European market, which is healthy, and that's why it's a sector that we've been allocating to over the last, or a region that we've been allocating to over the last 6 months.
You also like sectors linked to transition capex. You say the era of underinvestment in the real economy is coming to a close. Is this a medium to long-term play? Where are the opportunities when it comes to capex and getting exposure to that?
Yeah, so this is more of a medium-term play. But when we look at the world post-pandemic, post the invasion of Ukraine, things have obviously changed, and the key overriding theme within that would be security. Security of energy, security of food, even security of labor, as we talk about, those tight supply-demand dynamics within the labor market. And so those to us are enduring themes that point to quite a different composition of equity holdings this cycle versus last. More industrials, more consumer stocks, and more focus on construction and materials generally, which also provides quite a nice hedge should the landing point for inflation over the medium term also be higher, because these more pro-cyclical sectors would tend to do better in a higher inflationary environment.
Okay, as you come back to the inflation question, then it brings me on to your views around the bond market, fixed income, and where you're finding opportunities. Have the moves in bonds kind of been overdone? Is there still an opportunity to get exposure there?
We've come a long way, and so we have been adding to duration specifically over the last 6 months, and we're very comfortable with that position. I think
so that's a clear preference for duration over the shorter dated.
Well, it's been a barbell strategy for us now. I mean, the curve is still inverted. If you look at the 2s, 10s, you're still seeing opportunities at the front end of the curve, looking at 1 to 3 year investment grade credit, whether it be in euros or in dollars. We still think that's very appealing, because whilst you've had a compression in those yields, you've still got an inverted yield curve. So that, I think, is still an area for new money. I think when it comes to duration, and we're looking at 6 to 7 years, and when it comes to US, as I say, investment grade credit, we would like to see a backup in yield yields because of how far we've come so far, you know, another 30 to 50 basis points on yields, and we'd certainly be adding. But I think given how the market has priced out so many rate hikes just over the last few weeks, we'd probably put a pause on actively adding to duration here.
Okay, Grace, excellent as ever. Thank you very much for joining us this Tuesday to really kick off the week with views there. Maybe you sell some tech, maybe you get exposure to 6, 7 year investment grade in the US, and maybe start to shift out of US equities more broadly and look to other regions. Possibly Europe is looking better positioned at this point. Of course, JP Morgan Bank's EMEA head of investment strategy, Grace Peters, thank you very much indeed. Coming up, the Swiss government is set to be grilled in Parliament today over the takeover, of course, of Credit Suisse by UBS. We're going to read the details and a preview of what is expected to unfold in the Swiss Parliament and the pressure on the government. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding, and the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg Surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point.
Is this basically just whack-a-mole?
Inflation in Focus, Wednesday on Bloomberg.
Welcome back to the Open. We are 12 minutes into the European trading day. Positive sentiment across these European equities. Gains of 0.7%. Futures in the US pointing to upside of a little under 0.1%. And across your sectors here in Europe, led by basic resources, gains of 2.6% on bets that may be going to get more stimulus coming through from the Chinese economy, given the softer than expected inflation print. Just one sector in the red at the moment, food and beverage down 0.3%. Now, less than a month after forcing through the creation of a Swiss banking juggernaut, the country's government is set to be grilled in Parliament this week. For more, let's bring in Bloomberg's Swiss Bureau Chief, Claudia Medler. Claudia, what are we expecting today, then?
Well, it's a very special session today. Just to put it into some context, these special sessions don't happen very often. They happened for Corona. They happened when Swiss Air went bankrupt about, well, over 20 years ago now. So it's a very, very special session, but not that much can actually happen. Like, the deal cannot be derailed, but still, you know, lawmakers, they didn't get a say in this. They want to voice their opinion. They're a bit like the shareholders that we saw last week at Credit Suisse and UBS. You know, nobody got a say in this, so now they want to voice their opinion and figure out ways and how they can still keep maybe a little bit of control here.
Claudia, there is an election coming up in Switzerland. How much of this then is going to be about grandstanding by politicians and lawmakers there? Or how much of it is actually about potential material influence they can bring to bear in terms of how this deal is going to be pursued and implemented?
Well, yeah, you could say it's an election year, and this is obviously a great platform to kind of showcase, you know, what your party stands for, and not all parties are doing equally well. As you know, in regard to this deal, as you know, the deal isn't really, it's not something that the Swiss public is really behind either, or at least based on the surveys that we saw last month. So yeah, there will be ways the MPs are going to try to, restrict the government's leeway in how this deal gets executed. There is some talk that they'll try to figure out ways on how to hold those responsible at Credit Suisse responsible for what's happened. There might also be some proposals on how to restrict or put restrictions on these 109 billion that have been guaranteed by the government, that money cannot be extended. Some are also demanding the overhaul of Switzerland's too big to fail regulation for systemically relevant banks. So there's a lot at play here, and you're right, it is an election year, so that's also part of what we're going to most likely see today. It all kicks off in about 2 hours' time.
Okay, another busy day there for Claudia Medler, of course, our Swiss Bureau Chief, and the team as they look ahead to that special parliamentary session in Switzerland. Thank you very much indeed. Now, New York Fed President John Williams, he's rejected the idea that aggressive rate increases accelerated financial strains highlighted by recent banking failures. Let's bring in our markets reporter, Valerie Teitel. Valerie, what were the key takeaways then from Fed Williams' speech? How is he putting aside the rate hikes that have come through, 5% for the Fed, and trying to disconnect that from the pressure across the banking system?
Yeah, Tom, I think many raised an eyebrow to his comment yesterday. Obviously, the rate hikes imposed pretty drastic losses across treasuries, which was one of the reasons why SVB ran into such trouble back in March. His comment, he specifically mentioned the pace of rate increases, that he doesn't think that was tied to the issues that the banking sector had back in March when it came to Silicon Valley Bank and Signature Bank. But there was one other comment that he made that I found interesting. He said that we haven't seen any clear signs of credit tightening, and we don't know how big those effects will be. Now, it's interesting to note that the New York Fed also released their monthly consumer credit survey that showed the share of households reporting credit harder to obtain versus a year ago hit a record high in March. So it's clearly starting to come through the soft survey data that this access to credit is deteriorating. This is a survey especially for consumers. We are a bit more worried about it when it comes to larger corporate credit access, but it's clearly pointing in the wrong direction even for the New York Fed survey data for March.
And meanwhile, data coming through last week then from the Federal Home Loan Bank issuance showing that demand from the banking sector has plunged. Can we take some relief from that? The dash for cash, is it over?
Yes, I think so. The Federal Home Bank is known as the lender of next to last resort. Now, borrowing from the FHLB hit a record, only just 2 weeks ago, around $300 billion they had to issue because these small banks were really trying to build a cash buffer in order to defend against any worries of further deposit flight. Now, that issuance last week fell to $37 billion. I think it's an early sign that the bank's rush for cash is easing, and we did see some of that in the H8 data from the Fed released on Friday, that their cash buffers have been rebuilt, and actually some of those banks are lowering those cash buffers.
Okay, so that demand from plus 300 billion to about 37 billion, significant, as you say. Valerie Teitel, our markets reporter, thank you very much indeed. Let's get the Bloomberg First Word News now with Samuel Etienne. Sam.
Morning, Tom. The Pentagon says a recent documents leak poses a very serious risk to U.S. national security. The Defense Department spokesman says the military is trying to figure out the scope and scale of the information leaked, which it describes as highly classified. The documents include details of the U.S. spying on allies and an assessment of weaknesses in Ukraine's military. And England's health service is set to be hit by a fresh 4-day strike by junior doctors. The staff, qualified medics in clinical training, want a 35% pay rise after years of below-inflation increases. The government says the walkouts risk patient safety and have been timed to maximise disruption after the Easter break. And Jess Staley has been accused of, quote, whining by the judge overseeing the litigation surrounding him and his former employer, J.P. Morgan, over his ties to sex offender Jeffrey Epstein. A U.S. district judge said Staley's argument for more time did not warrant a severance or a change to the October trial date. Staley says the allegations about him and his connections with Epstein are baseless. And China is planning to require security review of bots like ChatGPT before they're allowed to operate. Providers of the AI services must ensure content is accurate and neither discriminates nor endangers security. The draft government guidelines cast doubt over the bots unveiled by China's largest tech companies. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg.
Sam Etienne here in London, thank you. Now, coming up, we're going to look at your stocks on the move, including European chip makers. That's after TSMC over in Taiwan missed sales estimates. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Despite the remarkable resilience of consumer spending in the United States, in Europe, despite the uplift from China's reopening, global growth would remain below 3% as we projected it earlier this year. And what is more concerning, it would remain around 3% for the next 5 years.
The IMF's Kristalina Georgieva with a stark warning about the outlook for the global economy and global growth. We are 22 minutes into the European trading day. Let's check in on how these markets are performing then. There is still more optimism across European equities. Gains of 0.7% then after the Easter holiday. Futures in the US, S&P E-mini is looking to gain just a little under 0.1%. Across your sectors, it is basic resources that is top of the pack, and by quite some distance, 2.2%. You look at iron ore, you look at copper, gains there, but also, of course, Brent and WTI. The oil story may be a slightly different on the back of the surprise cuts to output from OPEC+, but it's the story out of China, the softer inflation data and expectations that maybe get more stimulus that seems to be putting some upside for these basic resources. Certainly the FTSE 100 gaining and a beneficiary on the back of that. The FTSE 100 trading at 7,786. That's a gain of 0.6%. But you're seeing gains across all the major indexes across Europe this Tuesday morning. Let's take a look at the key things that market participants are watching out for this week. President Biden visiting Belfast and the Republic of Ireland this week, marking the 25th anniversary of the Good Friday Agreement. He's expected to address Ireland's Parliament during his visit. Tomorrow, we get the latest inflation print out of the US. Expectations for 5.1% for the month of March. Alongside the latest Fed minutes, of course, Cleveland Fed President Loretta Mester has told Bloomberg last week that rates must move, quote, a bit higher. We're going to see if her colleagues are on the same page. And Thursday, we get the UK February GDP and other economic data, including industrial production and RICS housing prices for the UK. Bloomberg Economics believes a housing market correction is underway here in Britain. Now, the French Constitutional Council, meanwhile, has said that on Friday it will issue a ruling on Macron's controversial pension reforms. The council could pass or reject those reforms. Let's get your stocks to watch now. Stocks on the move with Joe Easton from our Equities Day on a day, I should say, when broadly these equity markets are looking to upside. Again, 0.7% across the major index, the European Stock 600. But at the individual corporate level, what's happening, Joe? What are you looking at?
That's right, Tom. So we've got a close eye on the semiconductor stocks today. This is following a couple of bits of news over the long weekend from Asia. So first of all, we've had Samsung having their worst profit, their smallest profit since 2009, the financial crisis, and also TSMC in Taiwan. They've missed estimates as well. However, as you can see from the screen, we're actually up around 0.8%, much of that to do with those broader market trends that you've mentioned, even as analysts expect some read across in companies like ASML and also Infineon as well. But as I say, more reacting to the macro news. Then we're looking at HelloFresh. This stock jumping today after a double upgrade over at JP Morgan. They only actually went underweight this stock around 2 months ago, but are already telling clients to buy, saying that the ready-made meal offering from the company will make up for a few people that are cancelling now on the recipe, the more traditional meal that they offer. As you can see, that stock up around 5%. That's one of the best performing shares in Europe today. Then I'm going to move over to Glencore. You mentioned some mining stocks just now. One of those jumping today around 3% is the UK listed firm. There's a bit of an individual story here as well with Teck over in the US. This is a Canadian firm listed in New York. They're telling investors today that Glencore would not be a good bidder for the firm. That's spurring some hope that that deal won't happen. Glencore rising some more. Finally, I'm looking at Accor. This is the luxury hotel firm upgraded over at Morgan Stanley. They reckon the luxury segment of the holiday market will be more resilient in the recession. That one up 2.5%.
Our markets and equities reporter Joe Easton, thank you very much indeed for running us through some of the stocks to watch. Coming up, despite increasing tensions between the world's two biggest economies, a top US Treasury official says he does not see a decoupling between the US and China. We discuss that next. This is Bloomberg. DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. European stocks follow Asian stocks higher. Treasury yields tick lower across the curve, while Bitcoin tops $30,000 for the first time since June. President Biden travels to Ireland to mark the 25th anniversary of the Good Friday Agreement, but talks with allies, including Rishi Sunak, could be overshadowed by a mounting intelligence crisis. Plus, China consumer and producer inflation show ongoing softness in March, bolstering the case for further stimulus. Let's check in on these markets. We're going to do a deep dive on the inflation picture out of China just in the next couple of minutes. And certainly the expectation that maybe more stimulus comes through the pipe seems to be propelling at least the basic resources. You see that reflected in iron ore, copper. You also have oil higher today, as well as investors continue to digest that surprise cut by OPEC+. Across the benchmark here in Europe, you're seeing gains of 0.7%. Some relative optimism then as we look to a week where we have the CPI print out of the US tomorrow, and then the start of Q1 earnings, with the banks taking the lead on Friday. The DAX gaining 105 points. Here in the UK, the FTSE 100 trading at 7,782, again there, of 41 points. Let's see how things are playing out across these sectors then. I flagged basic resources, top of the list still, gains of 2.2%. Autos and parts also performing well this Tuesday on the back of that Easter holiday, gains of 2%. At the bottom of the list, just one sector that is in the red, food and beverage, down 0.4%. Of course, leading into the earnings, the picture and the questions around margins will be in focus, with expectations from some that you're going to see a profit drop in terms of corporate profits of about 6.8% versus the previous quarter, I should say, of last year, the first quarter of last year. So earnings season getting underway on Friday. But before we get there, let's break down the inflation picture in China, because it's a very different story to the one unfolding in Europe, the UK and the US. China's consumer inflation slowed in March despite a pickup in economic activity, while producer prices contracted further. Very pleased to say we're joined in the studio, live and in person, by Sophia Horta-Acosta, our Chief China Markets Correspondent, for the details. Sophia, fantastic to have you. Sophia, I should say, fantastic to have you in the studio. Give us the key takeaways then from this inflation data and what it says about the policy approach of the PBOC and of officials in Beijing, what it means in terms of their ability to react to this economy.
Yes, I think that's exactly right, Tom. I mean, consumer demand is really weak in China, and that's incredibly different to, as you said, the picture that we had in the US and European economies. People aren't spending on big ticket items, people aren't spending on goods, they're spending more on services. So when you break down the data, you see that actually airline tickets, the prices there were up quite a lot, obviously from a low base. But really giving the PBOC room to do more to boost domestic demand. It's not just the fact that domestic demand is weak, we're no longer in kind of the wait and see period where, the economy has just reopened and the authorities have a bit more time to see where the data takes us, but also export growth is weak. So really China needing to ramp up demand both at home and abroad. Abroad, obviously, it can't control that. What it does do, Tom, is it gives the PBOC room to cut interest rates. This is a central bank that's been very, very timid when it comes to stimulus compared to what we saw with the Fed, ECB, and BOE during the pandemic. So economists are calling for potentially a rate cut in Q2. We could get some signs of more easing next week because that's when we get the data for April and also the PBOC's monthly lending operation. So they could cut interest rates then. I would say it's probably too soon. Wait and see is still very much the name of the game from the PBOC, but what the data shows us is that it doesn't really need to do that anymore.
Okay, really interesting that we're looking potentially for a rate cut coming through from the PBOC. So that's one potential, obviously powerful policy tool that they could reach for. Is there other steps? Are there other steps that the Finance Ministry or the PBOC could be taking to support growth in this economy, and as you say, move that demand, or at least rebalance that demand between services and goods? You're pointing out that goods remains pretty soft.
Yes, exactly. I mean, we could get tax breaks, we could get some kind of, and it does seem that consumers are waiting for some kind of incentives, to buy, let's say big ticket items, cars. The car sales market has been incredibly weak in China. Stuff like white goods, washing machines, dishwashers. People are still very reluctant to spend on that. They're waiting for employment picture to improve. They're waiting for income to improve. Let's not forget that it's not just the pandemic that has weakened the consumer sentiment in China. Is still very much the property market. So Beijing could also do more to boost that. We know that the property market is stabilizing, but it's still very, very low when it comes to prices and sales. So there's, again, more room for the PBOC to do more on the monetary side, but also not just on infrastructure spending, but also when it comes to investment and tax breaks and really kind of getting the consumer to spend more. I know that's a completely different picture to the US, and we're seeing kind of the hangover of that now with maybe on Wednesday with the US CPI figure coming in again. So it's very interesting that it's such a divergent path, Tom, between the US and China, the world's two major economies.
Well, it's that divergence that is so fascinating, isn't it? And outlining for us the potential policies they could reach for. Thank you very much indeed, Sophia Hilton-Costa, joining us in the studio to break down that inflation print out of China, and importantly, what it could mean in terms of the policy response from the PBOC and the Finance Ministry. Now to Japan, and the Bank of Japan's new governor, Kazuo Ueda, says his predecessor's policies are sticking around, at least for now. In his inaugural press conference, Ueda says the use of yield curve control is what the economy currently needs. Earlier, we spoke to Kazuo Moma, the former BOJ assistant governor. Take a listen.
Now, exchange rate is much stable, so I think the stability of exchange rate will be still the important element surrounding BOJ policy setting. Once, if the something like last year might happen again this year, based on depreciation of yen, BOJ will become under pressure to make some changes in the monetary policy.
Okay, let's cross over to Tokyo now and bring in Kazunori Takada. What were the key takeaways then from this presser, Kazuo?
Yes, so as you said, one of the key takeaways was the fact that he basically said that policy will remain unchanged for the time being. He did keep the door open for possible changes by saying how he would be open to a review, but any decision on changes in policy would he would want to consult other board members, as something that you would expect him to say. The other thing that happened, that sort of the news that came out last night, was he met Prime Minister Kishida for the first time as governor. And they basically agreed that the 2013 the accord between the government and the Bank of Japan would remain intact for the time being. In other words, sort of again, sort of reinforcing expectations that the BOJ will remain focused on trying to do what it takes to achieve the inflation target of 2%. So basically, it looks like status quo for the time being. He was quite sort of clear, I guess, in making that. Not huge surprise, given all the indications that he's given so far in the lead up in his parliamentary hearings. But however, the market did react slightly, just sort of dimming down the expectations of any sort of imminent move in the short term.
And we're seeing the yen currently trading at 133, just strengthening 0.3%. Bloomberg's Kazunori Takada, thank you, out of Tokyo on that press conference from, of course, the new BOJ governor. Coming up, 25 years on from the Good Friday Agreement, we're going to take a look at the impact of that treaty and discuss Biden's agenda as he heads to the region this week. Stay with us. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open. This Tuesday morning, gains of around 0.5%, moderating seeing the stronger upside that we saw at the start of the session, of course, 41 minutes into the trading session. Futures still pointing to very modest gains in the US on the S&P E-minis. Talking of the US, let's focus in on the impact of this intelligence leak then. The US Justice Department has opened a criminal investigation into the leak of highly classified Pentagon documents which appeared on social media sites recently. The FAR's report to show that the US spies on its allies and also include an assessment of weaknesses in Ukraine's military. Meanwhile, the US Treasury's top international official says the country is not seeking to decouple from China. This as relations between the two countries have deteriorated, of course, over recent years. Let's bring in Bloomberg's John Liu in Beijing, our executive editor for Greater China. John, fantastic to have you to pass the comments from the US Treasury official. What is your assessment? Is it a big surprise that they've suggested that they don't want to decouple? What is the nuance here?
Well, the nuance here is that Jay Shambaugh, the Undersecretary for International Affairs at the U.S. Treasury, did say that there are national security concerns that the U.S. is going to take into account. I think it will be hard to convince anybody in Beijing that the U.S. is not trying to decouple from China. We obviously had those comments from Xi Jinping himself during the National People's Congress, saying that the U.S. was leading a Western coalition to try and contain China. I think Beijing will see these comments from the Undersecretary as being academic, if not spinning what Washington is actually doing.
And meanwhile, John, we had the visit, of course, from the French President Macron, some controversy around his comments regarding Europe's stance when it comes to that relationship with China. At the same time, as we saw the Chinese response, the military response in terms of at least test fires and placing some aircraft and ships close to and into, in some cases, the identification zone around Taiwan. What is your assessment of where things stand in terms of the Taiwan threat and Beijing's response there?
Well, I think this is an example of how China is trying to go on a charm offensive around the world, especially in Europe, but how difficult that effort is going to be, because a lot of times this domestic considerations for Beijing are going to be in confrontation with what Beijing needs to do to paint itself as a contributing, magnanimous, good member of the international community. Beijing is on one hand trying to show that it's pushing for peace in Ukraine, trying to find some solution when it comes to the conflict with Russia. But at the same time, when it is provoked, when there are visits by the Taiwanese president, in this instance to the U.S., it feels obliged to show a strong hand, and that is in turn what we see with the drills around Taiwan, with the show of force in terms of warships and planes. And so again, in conflict with this charm offensive that Beijing is trying to do.
Okay, yes, so far from a unipolar response, kind of multiple different strategies at play there by Beijing to try and on one hand reassure and then, of course, draw the line when it comes to what it sees as its concerns around Taiwan. John Liu, thank you, of course, out of Beijing for the latest there. Let's get the Bloomberg Business Flash now with Sam Etienne here in London. Sam.
Tom, Apple's personal computer shipments have fallen by over 40% in the first quarter, marking the worst drop since the year 2000. According to International Data Corporation, shipments of all PC makers combined slumped by nearly 30% to 56 million units. IDC says the demand surge for PCs driven by pandemic-era remote work has evaporated. And the IMF says the outlook for global growth over the next 5 years is the weakest in more than 3 decades. The emergency lender is urging nations to avoid economic fragmentation and take steps to boost productivity. The IMF's medium-term GDP growth forecast of 3% per year compares with 3.8% achieved on average over the past 2 decades. And Australia is preparing to host its first senior Chinese official in 6 years, in a sign of warming relations between the two nations. Ties started deteriorating in 2017 after Australia introduced anti-foreign interference laws that Beijing believed targeted China. China describes the visit by its vice foreign minister as a new round of consultation. That's your Bloomberg Business Flash, Tom.
Sam here in London, thank you. Now, US President Joe Biden arrives in Belfast in Northern Ireland tonight for the 25th anniversary of the Good Friday Agreement. Joining us now is our UK correspondent Lizzie Burden with more details of the trip. Lizzie, how do we expect this trip to unfold then?
Well, we're expecting Rishi Sunak to meet Joe Biden off Air Force One, and they'll have a proper sit-down tomorrow before Joe Biden makes a speech and then heads south of the border to Dublin. Of course, he's very, very proud of his Irish roots. He's going to be flaunting them in the run-up to the presidential election in 2024. But it has to be said that the backdrop to these commemorations is, of course, that power sharing hasn't yet been restored in Stormont, the Northern Ireland Assembly, despite the progress Rishi Sunak has made on the Brexit deal. Now, Joe Biden's going to be lobbying the Democratic Unionist Party to restore power sharing. Rishi Sunak's team's likely to lobby his team for a US trade deal. But it still has to be said that the reason for these commemorations is that the Good Friday Agreement remains globally a model for peace and reconciliation around the world. And even if Sunak's deal hasn't brought the DUP back to the table, it's still advanced his party in the polls. The gap between the Conservatives and Labour is now at its narrowest since Sunak took office in number 10. And now the Telegraph's reporting that we're going to expect a general election in October, November 2024.
October or November of next year as he makes up some of that, at least some of that lost ground. You mentioned Brexit, and there has been some question mark as to whether or not we're getting closer potentially if not in the short term, the medium term maybe, for a united Ireland. What are the real prospects of that, and to what extent could that overshadow this visit by the US president?
Well, of course, it has been a question that's gained traction because, of course, Sinn Féin, the Nationalist Party, became the largest party in Northern Ireland at the May elections last year. But despite that, there was a poll by Ipsos in December last year which showed that even if there were a reunification referendum, a majority of people in Northern Ireland wouldn't vote in favour. And to get that referendum in the first place, the UK government would have to give it the nod in Westminster, and that doesn't look likely. Another interesting development is that the Cross-Community Alliance Party became the third biggest party in those same elections. It doubled its seats, but the Good Friday Agreement gives priority to parties that designate themselves as either nationalist or unionist. Could there be a tweak there? Those questions, both of them, are not the questions for today. The question for now is how and when power sharing is going to be restored at Stormont.
Is a US-UK trade deal, is that a question for today, or is that pie in the sky, wishful thinking from UK ministers?
I'd say it's less pie in the sky than it was, given Joe Biden's focus on the domestic economy, given all the difficulties over Brexit. Sunak's team's going to be hoping that their progress on Northern Ireland unlocks the door to a US-UK trade deal, and that what we understand at Bloomberg is that it's going to be a multi-stage approach, starting with the things that have already been agreed with Donald Trump and ending with the hairier bits of a negotiation, like tariffs, like market access.
Okay, Lizzie Burden with that preview, of course, the importance of that US presidential visit to Northern Ireland and Ireland to mark the 25th anniversary, of course, of the Good Friday Agreement. Thank you. Coming up, a closer look at why Apple's Mac shipments declined by over 40% in the first quarter. We're going to talk tech. That is next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
DOJ or other authorities
could face bigger challenges next.
was going to keep rain World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
Welcome back to the Open. We are 52 minutes into the European trading day. You're going a softer dollar, down about 0.3%. That's feeding into some of the optimism across these equities. Gains of 0.6% across European stocks. And futures in the US just holding up. Gains of 0.1% being flagged by the S&P E-minis. You also have yields coming off across the curve on the treasuries. 3.97 on the 2-year, 3.38 on the benchmark 10-year. Now to all things corporate, and particularly with a focus on technology. Apple's personal computer shipments have fallen by over 40% in the first quarter. That is according to estimates from the International Data Corporation, IDC. It marks the worst drop since the year 2000. Joining us for a tech roundup then is Bloomberg's Alex Webb. Alex, how bad is this for Apple?
Well, I mean, look, Macs are not the lion's share by any stretch of the imagination of their revenue. That's the stark contrast to the year 2000, when, as you say, they fell, this much. There's really a perfect storm for a number of things happening here. You've got the fact they had a new Mac last year, which means that there's quite a tough comparison, because when a new Mac comes in, sales tend to jump. You then had really good sales in the pandemic, as there was a little bit just more disposable income in some quarters. You had companies buying hardware for their employees so they could work better from home. That also boosted sales. And then the third thing, of course, this is very much a discretionary product. You don't upgrade your laptop every 2 years or even every 3 years. It can last quite a lot longer than that. That means people, if they don't really need it, they are not buying it.
That's the context, and that's important. Meanwhile, a major supplier to Apple, particularly iPhone, TSMC, over in Taiwan, reporting earnings that came in below the estimates. What does that tell us about the demand for chips? Do we expect it to continue? How worrying is this for the semiconductor space?
We had seen a little bit of hope actually emanating from the chip industry in recent weeks. We saw, Micron coming in with numbers that were better than expected. We've seen Samsung saying they're going to cut production a bit, which is good for pricing of chips. TSMC below expectations. That really points to demand in things like, of course, smartphones, personal computers, but also some of the car industry. They're not selling as many cars, but they are selling them at a higher price. The supplier doesn't benefit from those higher prices, it just benefits from the unit sales. So that is something that it is feeling the pain from. It is nonetheless saying that in the second half of this year, there will be a recovery in demand, and that will benefit its numbers.
Okay, so there's an expected recovery in demand in the second half of this year. And you touched on the auto space, and you've been all across Tesla from kind of day one. And we're getting now these price cuts. Well, it's the second price cut this year? We're only in April. Second price cut this year for Tesla. What does that tell us? Is this a question of market share? Is it a question of margin resilience? What do we read into this?
So Elon Musk has some pretty punchy growth goals for Tesla. The last year, the target was for 50% unit sale growth. Ultimately, they came in at about 40%. In the first quarter, that was 36%. So this is a really ramping up efforts to sell more units. It's an interesting choice from a kind of corporate strategy perspective, when you've seen generally a flight out of growth stocks and more towards value. Tesla actually is a company that was starting to offer quite a lot better value. It's got very generous gross margins. It calculates them slightly differently from some of its competitors, but in the sort of low 20% range. Now that's expected to come down 2 or 3 percentage points as it brings in more of these discounts. So it is interesting they're still chasing growth. It's a big target they're going for. There's a lot of skepticism about whether they can hit it without even more cost cuts or price cuts.
Yeah, that was interesting, wasn't it? Some analysts saying, look, you should brace yourself for further cuts going forward from Tesla. Alex Webb, always excellent, of course, covering all things Apple, TSMC, and of course Tesla for us. Thank you. That is it for the European market open. Surveillance Early Edition is up next. Before we get there, let's briefly check in on these markets then. The relative optimism this Tuesday morning as people come back from the extended Easter holidays continues. 0.5% across European equities. The FTSE 100 trading at 7,769. That's a gain of 0.3%. And across your sectors, it is basic resources that is topping the list. Gains of 2.2%. Iron ore and copper higher. Food and beverage at the bottom of the list, down 0.6%. Stay with us. This is Bloomberg.
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. European stocks follow Asia into the green. Treasury yields tick lower across the curve while Bitcoin tops $30,000 for the first time since June. President Biden travels to Ireland to mark the 25th anniversary of the Good Friday Agreement, but talks with allies, including Rishi Sunak, could be overshadowed by a mounting intelligence crisis. Plus, China consumer and producer inflation show ongoing softness in March, bolstering the case for further stimulus. It's an hour into your cash equity trade, and the post-Easter holiday cheer is easily continuing in this market. But how sustainable is it exactly? European equities up 0.5%. Almost every sector is in the green this morning except for food, beverage, and tobacco. So even more of a safety play not doing well, but things like real estate, autos, higher beta sectors, those doing well. That's also reflected in the fact that Bitcoin is above $30,000. But volumes are thin. Trading is thin. So this is moving on perhaps not a clear driver considering some of the turmoil in the sector, but we are up another 3% this morning. German two-year yields, the cash trade in Germany opened for the first time since the long weekend. It has some cash up to do with American jobs report. An American jobs report, which I should say was very middle of the road, but perhaps that was enough to increase some short bets on short-dated treasuries. At least that's what hedge funds did going into the decision. So German two-year yields move higher by nearly 8 basis points. Finally, euro versus the dollar. Euro getting some strength. It was all about dollar strength yesterday. The FX market, of course, has been open throughout the holidays. But we are seeing some euro strength, perhaps some nervousness around that China data and what it means for a global inflationary impulse. Perhaps China is not going to contribute too much to that. All right, here's your look at Europe. Most things into the green except the IBEX. That is lower this morning. Again, for most of these regions, it is the first day of trading this week. So following on from a Wall Street session yesterday, was just slowly melted higher. Risk assets moving higher in the face of more warnings gathering around this economy. The IMF is the latest to issue such a warning, saying that the outlook for global economic growth over the next 5 years is the weakest in more than 3 decades. The emergency lender is urging nations to avoid economic fragmentation caused by geopolitical tensions and to take steps to boost productivity. Joining me now is Bloomberg's Christine Aquino. Christine, Again, more recessionary calls, this time from the IMF. Is this one different than perhaps we've heard from others?
Well, Danny, for this one, I think what really caught my eye is their expectation for rates to return to the ultra-low levels, right? Because we've kind of, as a market, collectively come to accept the idea that, yes, perhaps rates at the moment might be heading toward that restrictive level, and it might be warranted to see rate cuts down the line, but probably not a return to these ultra-level rates era that we've seen over the past decade. But the IMF is calling for exactly that. And I think part of their argument is, of course, due to the fact that there are a lot of aging populations, particularly in the developed world, and they're probably reading it via the jobs market impact on the overall economic productivity. Now, bear in mind, though, this is a long-term forecast. This is a matter of decades that they're seeing this playing out, but still very interesting that they're kind of harking back to the ultra-low rates era when, once the central bank started raising rates, we've kind of all just accepted that we're never going to get back to that.
Right, yeah, can you really go back to the old playbook we had? Joining Christine and me now also is Janet Mui, head of market analysis at RBC Bruin Dolphin. Janet, Christine and I were just talking about, again, the story that has been for the past year, mounting recessionary calls. Looking at that and looking at the really strong Treasury rally we've had to start this year, at what point do you want to start buying? Is it too late at this point to join that rally?
Hi, good morning, Danny. Thanks for having me. So we do think that Treasury yields will go back up a bit. We think the bond market is short-term overbought at the moment. So the direction of travel for us is that we want to add more to the sovereign bond market, particularly in the US. So we're waiting for that moment to come back. We think that it will come back because we think that markets are too optimistic on a few rate cuts this year. We think that the Fed has consistently communicated that they won't cut this year. And we think that inflation is still a problem. We can see the labor market is still very tight and core inflation is still very high. So we do think that that moment will come back. And then we think the direction of travel should be we'll buy bonds at that point.
Is there a particular entry point you're looking for?
We're closely watching the market situation. We think that probably the peak of the bond yield may have been passed already. Okay. We have previously added to UK yields because we think the UK economic situation would warrant UK bond yields to go a bit lower than the US. But we do think that the US Treasury will come back, but we don't particularly have a view on what particular level. We're closely watching at the moment.
Yeah, so bonds are attractive now, and Christine, maybe equities aren't. We do have Bank of America warning Michael Hartnett, saying that investors are too optimistic on rate cuts, not pessimistic enough on recession. We have seen equities be just so resilient this year.
Absolutely, Danny. And I think that's part of the hope that has been buoying equities is the fact that, if rate cuts are just around the corner, then that is particularly good for equities in the long run, just because it means that support from central banks is finally coming back to the economic system. But yeah, I think the idea that, yes, rate cuts are eventually going to be good for stocks, but before that, the scenario in which rate cuts will be needed, I think people aren't necessarily thinking about that at the moment. And I think that's what Bank of America is warning at the moment, is that it will require some kind of economic slowdown, perhaps even a recession, to precipitate those rate cuts, which of course, not going to be a great environment for stocks.
Exactly, not a great environment for corporates. We might get some hints of that, or maybe we won't. Janet, how are you thinking about this earnings season? Banks kick things off on Friday. Corporates have been resilient. Are we finally going to see some ruptures?
Yeah, I think we will start to finally see some weakness in the corporate sector. Primarily is because of the difficulty to defend the margins, because I think people can't really pay these high prices anymore. There's a degree of how much you can really squeeze the consumers. And we think that there are tentative signs that demand is slowing, particularly in, say, the PC sector and some other, electronic products primarily. So we think that there will be more questions on the durability of these margins. And I think people, of course, will be asking questions of what the latest banking stress means for, first of all, banks and corporates, credit conditions, etc. So I think there will be lots of question marks, and of course, it will be a huge focus.
Yeah, I think tech's a really interesting one because it has been just a market so concentrated in tech. I think the stat was 20 S&P 500 stocks account for 90% of Wall Street gains so far this year. That's very sort of tech bubble levels of concentration, Christine. How does that end?
Well, Danny, yeah, I mean, I think earnings season will be very informative for investors for sure. And I think what's kind of driven that move, right, is there's been kind of this division between profitless tech and the bigger tech sector, right, which I think has been responsible for a lot of that move. And so within the tech space itself, people have kind of carved out, okay, what are the havens and what are the riskier assets, quote unquote. But it's going to be interesting to see, again, from the likes of Google, your Alphabet, your Facebook, your big tech companies, how has the latest turmoil fed into their sector, especially because, you know, we've already been seeing job cuts, we've already been seeing a version of the slowdown in the tech sector prior to the broader version that we saw over the last month. And so it's going to be really interesting this earnings season to see what is their outlook moving forward. Are they more pessimistic than the rest of the sectors?
Yeah, and again, you know, we'll find out in coming weeks, so definitely will be interesting. Thank you both for joining, helping set us up for it. That's Janet Mui, Head of Market Analysis at RBC Brewin Dolphin, and of course, Bloomberg's Christine Aquino. Coming up on the program, Swiss government officials will meet tomorrow for a special session on using taxpayer money to support UBS taking over Credit Suisse. We'll have a bit of a preview for you next. This is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Less than a month after forcing through the creation of a Swiss banking giant, the country's government is set to be grilled in Parliament this week, starting today. Here with more is Bloomberg's Tom Metcalf. Tom, so what are we expecting from this special session?
Yeah, so we're basically expecting a lot of noise, but ultimately there's not much that can be done by these lawmakers to change the deal or anything like that. It has been agreed, it's been pushed through special ordinance. So really it's a chance for those politicians to sort of get out there, get their kind of talking points across. Very, very contentious topic in Switzerland at the moment, so I'm expecting, a lot of sort of fiery speeches, but ultimately the deal itself is sort of a separate matter and will continue as is.
But couldn't it result in, at least down the road, even, I guess, ironically, a breakup? Because I know there's been concerns of concentration in the Swiss banking sector, that you just now have this one giant.
Yeah, exactly, and that is still an open question. We know UBS are really keen to keep those Swiss operations, in-house, as it were. But yeah, no, I expect that's going to be one of the big topics. Those politicians coming out and saying, "Hey, this is doing the Swiss people a disservice. We need to have competition. What's wrong with trying to IPO, let's say, Credit Suisse's Swiss unit?" So yeah, that would probably be the most common topic they bring up.
Well, speaking of upswells of people having an impact, I know in Sweden, after the collapse of SVB, their pension fund came under a huge amount of stress. Alecta, one of the biggest pensions there, because they had big stakes. This morning we learned that the CEO is going to be departing immediately. Was this pretty much inevitable given what happened with their investments?
Well, look, the pressure has definitely been building. And so, yeah, they had a terrible set of investments. They were in SVB. They were also in Signature. So, they've lost something like 2 billion euros, I think it was, which obviously, pension holders are extremely angry about. And the company's been trying to manage it. A few weeks ago, you had the CEO effectively apologizing. But, the anger's been building. And, yeah, that sort of local sort of frustration at how this was happened means, really the CEO ultimately had no choice.
In terms of other fallouts from the banking sector in the U.S., we're still sort of combing through every piece of data we get when it comes to loans, when it comes to credit, anything like that. I know we got some data out recently, yesterday. Are things more calm yet?
It does look like that. So this is the data I think it's known as the lender of second last resort, basically. It's how banks will tap stuff to sort of ensure a bit more liquidity. And that's really dropped. So that's down to sort of much more normal levels. And it's just the latest piece of information out there which suggests, yes, perhaps the sort of the acute phase of this crisis has passed. You had Jamie Dimon saying that was his sense of things. And it does look like the data's starting to back that up, that at least this big volatility in US banking is starting to move.
So I guess it's the second order effects now, like a CEO having to leave a pension fund.
Exactly.
Tom, thank you so much. As always, that's Bloomberg's Tom Metcalf. All right, let's now get to your stocks on the move. With that is Joe Easton from our equities team. Joe, what you got for us?
That's right, Danny. So we're starting out looking at HelloFresh today. This one jumping after a surprising upgrade over at JP Morgan. They are going overweight, that stock, having only gone underweight just a couple of months ago. They say the fully packaged meal offering is going to make up for some of the lack of demand in the traditional recipe packages that did really well during the pandemic, but a lot of people now cancelling that due to the cost of living crisis. JP Morgan, however, turning a bit more positive. Then I think we're going to bring up on the screen at Glencore as well. Now, Glencore is jumping today along with the other miners. This is as, there we go, up on the screen, up 2.8%. This is as the company that it's attempting to buy, called Tech, over in the US, that's the Canadian firm listed in New York, is pushing back, saying that won't be a good deal. That would have cost Glencore more than $20 billion, and a lot of investors here in London didn't like that agreement at all, so they're a bit relieved that that might not happen, given the Canadian firm is turning a bit hostile on that one. Then I'm going to look at hotels. This one is one for the White Lotus fans, I think. This is the luxury hotel sector. Morgan Stanley really positive on that space this morning in a note, saying that luxury hotels globally could reach around $219 billion in annual revenue. That's around 50% of the luxury goods market, so we can see how big that is. And Accor in France would be one of the biggest beneficiaries and potentially see 20% annual growth in their sales, according to Morgan Stanley. Finally, we're going to look at semis. Really wanted to bring this up just because there's been way too much green on the screen today. Got a bit of red finally. This one down 5%. Nordic Semis is the worst performing stock in Europe today. They've had a price target downgrade by DNB, which is their corporate broker. And also we've had news of Samsung's weak earnings on Friday, and also TSMC over in Taiwan. Those are feeding in. This is a customer of theirs. Bit of negativity. Finally, bit of negativity on the screen. As I say, the worst performer on the Stock 600 is Nordic Semiconductor.
Okay, Joe, thank you so much for that. That's Bloomberg's Joe Easton on the stocks on the move. Coming up, a U.S. intelligence leak poses what the Pentagon calls a serious threat to national security. We have that for you next. This is Bloomberg.
energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get your first word news now. With that is Leanne Gerrans. Good morning, Leanne.
Danny, good morning to you. The IMF says the outlook for global growth over the next 5 years is the weakest in more than 3 decades. The emergency lender is urging nations to avoid economic fragmentation and to take steps to boost productivity. The IMF's medium-term GDP growth forecast of 3% year compares with 3.8% achieved on average over the past 2 decades. Now, England's health service is set to be hit by a fresh 4-day strike by junior doctors. The staff, qualified medics and clinical training, want a 35% pay rise after years of below-inflation increases. The government says the walkouts risk patient safety and have been timed to maximise disruption, and that's after the Easter break. Now, Jez Staley has been accused of whining by a judge overseeing the litigation surrounding him and his former employer, JP Morgan, over his ties to the sex offender Jeffrey Epstein. A U.S. district judge said Staley's argument for more time did not warrant a severance for or a change to the October trial date. Staley says the allegations about him and his connections with Epstein are baseless. And Australia is preparing to host its first senior Chinese official in 6 years, in a sign of warming relations between the two nations. Ties started deteriorating in 2017 after Australia introduced anti-foreign interference laws that Beijing believed targeted China. China describes the visits by its vice foreign minister as a new round of consultation. China is planning to require a security review of bots like ChatGPT before they're allowed to operate. Providers of the generative AI service must ensure content is accurate and neither discriminates nor endangers security. The draft government guidelines cast uncertainty over the bots unveiled by China's largest tech companies. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you very much. The U.S. Justice Department has opened a criminal investigation into the leak of highly classified Pentagon documents, which include information about how the U.S. spies on foreign countries. The Pentagon says the leak poses a very serious risk to national security. Joining us now is Bloomberg's Mark Champion on this. Mark, first the basics. What more do we know about this leak?
Well, the first is that we know that it was not the kind of leak that we saw, via WikiLeaks, where you had digitally hacked documents in their tens of thousands. So this is a smaller number of documents. There are photographs taken of them, so it very much suggests that it's a leak by an official. But it's nevertheless serious because what it really does is to, indicate, first of all, to allies that, yes, the US is still spying on them, as the Snowden controversy suggested some years ago. And secondly, it also reveals really quite operative information about the state of the Ukrainian forces in Ukraine, their preparations for an offensive, the chances of that happening, and above all, the state of their stockpiles of anti-aircraft weapons.
And as you say, that this is very sensitive, especially when it comes to information about spying on allies. What have the reactions across the globe been?
In public, quite reserved. In South Korea, there was a very public denial saying that, these were falsified documents. However, nobody, sort of behind the scenes, nobody is denying that this is going to cause some problems for the U.S., and the U.S. is already quite heavily engaged in damage control.
And then to the other point you made in terms of any weaknesses in Ukraine's military, what sort of impact could the leak of that information have?
Well, the real concern is that many of these things were kind of suspected or talked about by analysts, and of course Russia has its own sources. It's within Ukraine, and so it may have its own intelligence. It's hard to know exactly how much of this will be new to the Russians. However, what it really does do is to say, of Ukraine that they are running out of anti-aircraft weapons, which is absolutely critical. They cannot succeed in a counteroffensive, and they will really struggle to prevent a counteroffensive by the Russians as soon as they have no means of protecting themselves against the Russian Air Force, which has been preserved, having failed at the beginning of the war to get air supremacy. It has been preserved since.
Okay, Mark, thank you very much for that update. That's Bloomberg's Mark Champion on the Pentagon leak. Now, coming up, the latest Chinese inflation figures suggest a muted economy in March. Could there be more stimulus ahead? This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Business Week Radio, live weekday weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg. European stocks follow Asia into the green. Treasury yields tick lower across the curve while Bitcoin tops $30,000 for the first time since June. President Biden travels to Ireland to mark the 25th anniversary of the Good Friday Agreement, but talks with allies, including Rishi Sunak, could be overshadowed by a mounting intelligence crisis. Plus, China consumer and producer inflation show ongoing softness in March, bolstering the case for further stimulus. Good morning. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Francine Lacqua is off this week. Now, I mentioned that data coming out of China. It showed that consumer inflation slowed in March and producer prices contracted even further. CPI in the year to March was 0.7%, weaker than the 1% forecast by Bloomberg economists in a survey of economists by Bloomberg. Producer prices fell 2.5% over the same period. Here with us in London, a visit over from Hong Kong, is Bloomberg Sofia Orta y Costa. Sophia, so with this data, I know globally it had a reaction because perhaps China isn't this big inflationary impulse that we thought it was. But locally, how did Chinese and Asia markets react to it?
Yeah, exactly, Danny. I mean, we saw a little bit of a move in the yuan that weakened a little bit because it does bolster the case for more stimulus. And stocks had quite a bid on the back of this. Again, the story is that the bad data on this front bolsters the case for more stimulus. It really gives the PBOC room to inject more support into the economy because the PBOC, the central bank in China, is still very much in a wait-and-see mode. And what this data and what economists are saying when we spoke to them this morning was that really the authorities don't need to do this anymore. You don't have those kind of price pressures that we had here in European economies and in the US. So markets taking this positively. It's not a kind of a at the end of the day, it still suggests that domestic demand in China remains weak and also exports demand remains weak, and that's the producer and consumer prices. So there is more work to be done. The scope for disappointment is obviously high because if the PBOC doesn't follow through, if Beijing doesn't do anything to bolster growth and continues to wait, then we could get a bit of frustration in markets, Danny.
Yeah, because I was going to ask what sort of the line is between, okay, we keep policy easy, we don't tighten, we obviously don't need to, versus easing further. Does this meet that bar, this type of data?
I think, the first quarter was all about the economy had just reopened. Let's not forget that China took a lot longer to reopen from or to kind of end COVID zero. It was only in December and only really in January after the Lunar New Year holiday that consumers could go out, could go traveling, spend. So it really made sense from a kind of policy point of view to wait and see. Now the case is weaker for that. The wait and see strategy no longer makes sense. We do get data, GDP data next week. I think that could be a big one. Also industrial production, retail sales, that could kind of point us in either direction. And the PBOC, the central bank, has another window to cut interest rates next week. I think it might be a bit too early for the PBOC to do that. It's kind of a far less aggressive central bank when it comes to policy compared to the Fed, the ECB, and the BOE, in terms of supporting the economy during COVID. So it's likely to maintain that stance. But in terms of, small stimulus measures like encouraging people to go out and buy more cars, adding subsidies that get people out to buy electronics, this is something that can really, when you have a domestic economy the size of China's, this can really kind of move the needle. So more calls for that.
I think the news gods might be hearing what you're saying because we just did get some headlines coming out that March aggregate financing in China beating by a really large number, 5,380 yuan. The estimate was 4,500. New loans, a large beat as well. So kind of goes to what you're speaking as well, sort of getting the domestic economy up and running. Sophia, thank you so much for joining. That's Bloomberg Sophia Orta y Costa. Now, new BOJ Governor Kazuo Ueda says the use of yield curve control and negative rates are still appropriate for the Japanese economy. At the same time, elsewhere in Japanese markets, billionaire investor Warren Buffett told the Nikkei he's turning his focus back to Japan. Joining us now to discuss is our Japan economics and government editor, Yuko Takeda. So Yuko, the Ueda era has officially begun. What did we learn from his inaugural presser?
Yes, so the Ueda era has officially begun as of yesterday, and the message we're getting so far is no immediate change, basically. Ueda said during his inaugural presser that the YCC should stay, the negative rates should stay, and the BOJ's easing bias itself, it should stay. So the message we're getting from him from his first ever presser as BOJ governor is that he doesn't plan on any sudden changes here. And it strikes a big contrast with his predecessor, Schroeder, who in his first inaugural presser sort of came in and said, I'm going to shake things up, I'm going to change things. But Ueda, so far, the message we're getting is that things are going to remain the same for now.
I wonder how much of this, Yuko, is this idea of needing consensus first. We know Ueda met with Prime Minister Kishida before the presser to say they'll keep the 2013 joint agreement unchanged for now. What's the significance of that? And again, does Ueda need more of a consensus before he can make any changes rather than coming in and changing things at the first brush?
Right, so that 2013 joint agreement basically tied the BOJ to easing, and that messaging from Ueda and Kishida yesterday that they won't change this immediately is another sort of signal that they're not in a rush to change things. On whether he needs additional backing to change things up, you can sort of say that Schroeder before him already had the backing of Abe at that time, and that's why he was able to shake things up. So without perhaps government backing or government agreement in the back, at his back, it may be difficult for Ueda to completely change things up going forward.
Now, elsewhere in Japanese markets, Warren Buffett was giving an interview to the Nikkei saying that he's thinking of buying more Japanese stocks. We saw the reaction immediately, as we typically do, in response to a Buffett comment. But what do we know about what exactly he's looking at buying?
Right, he wasn't too clear judging from the Nikkei article itself. He's already made news saying that he's bought Japanese trading house shares, and in the Nikkei interview itself, it seems like he's added to those holdings, but he kept his comments fairly vague in terms of where else he's going to buy. The hint was that he's looking to buy more Japanese shares, whether it's more trading house shares or other sectors, but looking at the article itself, it didn't seem quite clear what exactly he's looking to buy. That said, this could be a catalyst for more foreign investors to buy Japanese shares, particularly those who are that are undervalued at the moment.
Okay, Yuko, thank you so much for joining us. That's Bloomberg's Yuko Takeo in Tokyo. Now, coming up on the program, 25 years on from the Good Friday Agreement, we're going to take a look at not just the impact of the treaty, but Biden's agenda when he visits the region this week. This is Bloomberg.
book about YouTube now. Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg Surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point. Is this basically just whack-a-mole?
Inflation in Focus. Wednesday on Bloomberg.
"25 years ago, politicians in Belfast signed the Good Friday Agreement, officially ending more than 30 years of conflict in Northern Ireland. Known as the Troubles, around 3,500 people were killed in violence including bombings and rioting. The prospect of peace and a stable, devolved government was met with overwhelming support. Tony Blair, Bertie Ahern and Bill Clinton played a key role in helping hammer out the agreement. It was based on power sharing between mostly Catholic nationalists who favoured independence and Protestant unionists wanting to preserve ties with the UK. But the journey hasn't always been smooth, and distrust remains, along with continued instances of violence.
We are dealing with a divided society. We wish it wasn't, but it is. And, you know, it's going to need tender and noble care for a long time.
The Northern Ireland Assembly at Stormont has been unable to function for 40% of its lifespan due to disagreements between the sides. Most recently, the Executive Committee hasn't met since February 2022, discourse spurred in part by post-Brexit trading arrangements. While not suspended, no major decisions can be made. But despite many continuing challenges, optimism remains.
Whatever the problems in Northern Ireland, what people should never forget, it's a world better from where it was. And if we exercise common sense and realism today, we can keep the peace intact.
That was Bloomberg's Louise Moon on the historical significance of the Good Friday Agreement. Now, staying on this topic, U.S. President Joe Biden arrives in Belfast tonight for its 25th anniversary, that landmark of the deal. Joining us now to discuss is Bloomberg's UK government reporter Alex Wickham and our Dublin bureau chief Morwenna Coniam. Morwenna, let me start with you. So we know Biden is very proud of his Irish heritage, but what is his aim? What is his objective on this visit?
Well, ostensibly, I'd say it's two main things. One is it is meant to be a celebration of the Good Friday Agreement, 25 years of, predominantly peace in Northern Ireland, which really cannot be underestimated. It is something that a lot of people thought would never happen, including very close to 1998 when the deal was signed. It's also an opportunity for him to celebrate his Irish heritage, particularly when he comes to the Republic of Ireland later this week. And he'll be visiting some of the counties where his ancestors were from, as well as meeting with the Irish Prime Minister, Leo Varadkar, where there will be some bilateral talks on issues of common interest.
And get into that a little bit more in terms of the agenda when he's in the Republic of Ireland. You mentioned a few things there, but politically, any sort of outcomes that the Biden administration is hoping for?
I think it's been largely quite closed in terms of the exact agenda there, but one thing is, it again is celebrating the achievements of the Good Friday Agreement, but also reassuring and reminding of the US's commitment to helping ensure peace and stability across the whole of the island of Ireland, which, they were all involved very closely with the negotiations of the Good Friday Agreement 25 years ago. In terms of policy issues, there's lots of things in the world at the moment that they have a shared view on. We haven't had too many specifics, although it is understood that the US may want to recognize Ireland's role in enabling the minimum tax deal that was signed by the OECD in 2021 to come about. Ireland played a huge part in that. As well as Leo Varadkar mentioned last week that they might be discussing some cybersecurity issues, given particularly there's a lot of big US multinational companies based in Ireland.
Alex, let me bring you into the conversation. So that's how things might unfold when it comes to Biden's visit to Ireland. But in some ways, is this also a reset of US-UK relations?
I think certainly the UK government would like it to be that way. Rishi Sunak, the UK Prime Minister, is certainly keen to impress Joe Biden and have a good relationship with Joe Biden. And UK-US relations have been a little bit strained on some areas under the Biden administration, on Brexit in particular. The Northern Ireland issue, which has gone on for years unresolved, this dispute of post-Brexit trading arrangements, finally sort of resolved in the last few weeks by Rishi Sunak's government. And certainly this is something that the Biden administration have been privately lobbying the UK government to get over the line, this deal on Northern Ireland. So I think Rishi Sunak would absolutely hope that Biden can come and it could be a bit of a happy moment for all involved and a bit of a move back towards positive relations.
Well, given that the trade issue with Northern Ireland, that hurdle has been overcome, what are the prospects for a UK-US trade deal?
This is a big question. It's something that the Brexiteers in Britain, Rishi Sunak, of course, one of those, have really wanted. A free trade agreement with the US has been seen as a big prize of Brexit, potentially. However, under the Biden administration, it's just simply been off the table, and I think that remains the case. The Biden administration not really that interested in FTAs with not just Britain, but other countries. It's not really their thing. What Britain does want to do, though, is just restart those trade talks, not towards a full FTA, but towards something approaching that direction, certainly closer relations for SMEs, things like that. And this is something that's really stalled in the last few months as the Biden administration was pretty upset with some of the UK's hardline rhetoric on Northern Ireland over the last year or so. But now that's sort of smoothed over. This is something that Sunak and his team will be lobbying the White House team for.
Okay. Alex, Morwenna, thank you both so much for helping us set up the Biden visit to the region. That's Bloomberg's Alex Wickham and Morwenna Coniam. Now, we're going to be covering all things UK every single week on Thursdays. That's at 9:30 a.m. London time on our half-hour special. Coming up, Apple Mac shipments slumped to their lowest since the early 2000s, and the iPhone maker plans to open its first stores in India. All of that for you next. This is Bloomberg.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to your Bloomberg Business Flash now. With that is Leanne Gerrans. Leanne.
Hi, Danny. The Confederation of British Industry has named its former chief economist, Rain Newton-Smith, as its new Director General. Newton-Smith will replace Tony Danker, who is dismissed with immediate effect following a probe into workplace misconduct. The CBI board says Danker's conduct fell short of that expected of the Director General, but he is not the subject of any of the more recent allegations into a wider investigation. Now, the IMF says the outlook for global growth over the next 5 years is the weakest in more than 3 decades. The emergency lender is urging nations to avoid economic fragmentation and to take steps to boost productivity. The IMF's medium-term GDP growth forecast for 3% per year compares with 3.8% achieved on average over the past 2 decades. Australia is preparing to host its first senior Chinese official in 6 years in a sign of warming relations between the two nations. Ties started deteriorating in 2017 after Australia introduced anti-foreign interference law that Beijing believed targeted China. China describes the visit by its vice foreign minister as a new round of consultation. And that's your Bloomberg Business Flash. Danny.
Leanne, thank you very much. Now, Apple's personal computer shipments dropped 40% in the first quarter, the worst 3-month drop since early 2000. According to International Data Corporation, shipments of all PC makers combined slumped by nearly 30% to 56 million units. Joining us now to discuss is Bloomberg's Alex Webb. Alex, Apple Mac shipments slumping according to IDC. What's the driver behind this?
It's a bit of a perfect storm, really, because you've got a really tough comparison on last year where you had 2 factors really driving shipments up. Firstly, they had a range of new models, which kind of drives refreshes. You still had people spending money and, importantly, companies spending money on new hardware, in the course of the pandemic, as there was, for some people, a little bit more disposable income. For companies, people working from home that you needed to kit out, or they felt they needed to kit out with the top stuff. That was making things hard on the comparison side. Then you have, at the moment, just a really tight economic environment where the laptops and Macs are very much a discretionary spending item. Do people need new Macs? Not necessarily. They have a longer lifespan, maybe 3, 4, 5 years rather than the 2, 3 years you might think of typically with a handset. You put all those things together and you end up with this drop.
So it's the economic environment, but it also maybe to some degree is the geopolitical environment that Apple is trying to navigate. In December, there are, of course, those reports that Apple was looking at moving some production away from China. And this morning we learned that Tim Cook has said that Apple is going to open some of its first stores in India soon. Is this part of that shift away from China?
Well, it is, but maybe not in the way that you would expect. One of the reasons, in order to open an own brand store in India, you have to have a certain proportion of the items sold in the store coming from India itself. So the fact that Apple is bringing more production to India may in fact help it open stores in the country. Now clearly it's not bringing manufacturing there solely so that it could open stores. India is of course a massive captive market, and I think as far as Apple is concerned, untapped. It's at a stage where China maybe was a few years ago. So it's because they've got more manufacturing there that it's made it easier for them to think about opening stores in the country.
Alex, before we let you go, I want to ask you about Tesla, because shares fell yesterday. Yet again, Tesla marked down the share, the price of the vehicles. And you and I, every time you come on, we've had this conversation about these tech companies wanting to not follow that model of growth at any cost. Is this Tesla still following growth at any cost?
Yeah, it's kind of interesting when you particularly compare it to, say, Meta, which is saying this is going to be the year of savings when we really knuckle down on cutting costs. Well, Tesla's not necessarily expanding its costs, but it is taking a bit of a hit to its gross margin by cutting the cost of its models. Right. And it's trying to continue growing unit sales. You could say, on the other hand, it's actually taking share away from other electric car makers who have a higher cost base than Tesla does. Nonetheless, the street is forecasting a 2 to 3 percentage point hit to the gross margin this year as it expands those price cuts, right. I should say, my apologies. It is a little bit counter to what the rest of the market is doing right now, where it's saying, actually, no, there is some value to be found with us. Tesla could be a company that generates a lot of value, does now have, relatively healthy free cash flows. That's something that would get investors in the current climate more excited. The stock has recovered a little bit this year. It is still down something like 50% from its peaks in last year. So, yeah, it's an interesting strategy that's counter to what a lot of other people are doing.
Right. Yeah, and I guess if share prices can continue to recover, at least hold, maybe it shows that, hey, perhaps being a growth stock, it's okay right now.
Well, it declined yesterday on those
on
some of this news, so it's a slightly risky strategy, perhaps.
Fair enough. Alex, thank you very much. That's Bloomberg's Alex Webb. Later in programming, don't miss our interview. We're going to be speaking with John Bolton, the United States former National Security Advisor under former President Donald Trump at 6:40 p.m. London time. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? The why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We've never seen this much tightening without a recession.
There's a lot more resilience in this economy than you thought. Now, I still think you're going to go into a second-half recession, but not all recessions are created equal.
Even if we don't have a really deep recession, it still means that the stock market's got further to fall. And I think there's a very good chance that we'll test and maybe even undercut the lows of last October.
This is Bloomberg Surveillance, early edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Bitcoin goes over $30,000 for the first time since June. It's now up more than 80% this year. The Pentagon warns that those leaked intelligence documents are a threat to security. Prosecutors want to find out who is responsible. And there's an early sign that the banking crisis in the United States has started to subside. Meanwhile, New York Fed President John Williams says the central bank's rapid interest rate hikes didn't cause the turmoil. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. We're still talking about whether we will and to what extent see a recession in the United States and in other parts of the world. Matt, the focus this week, though, could really be on that inflation data out of the U.S.
Yeah, absolutely. Looking forward to that data to determine what the Fed is going to do. I think the consensus is pretty strong that we're going to have a recession here in the U.S. in the next couple of quarters. Take a look at what's going on in stocks. It hasn't affected futures. We're still up after a positive close on the S&P 500 in the cash trade yesterday. Only 0.2% gain, but you're seeing rates continue to come down. The 2-year under 4%, the 10-year now under 340 at 338.68, and that gives a little bit of a tailwind to stocks. NYMEX crude has been holding at $80 essentially since last Monday after the surprise cut by OPEC, and it hasn't moved much out of that range. NYMEX around 80, Brent around 85. It seems to be fairly stable. Bitcoin had been fairly stable at around 27,000, 28,000 for a while. It's now jumped up over $30,000 for the first time since June. So the digital asset at $30,104.82, something we're going to be talking about a lot more throughout the day because it definitely moves markets in terms of anything related to crypto up, regardless of the other news on, for example, Coinbase or Block. If they've been downgraded by analysts yesterday, it doesn't matter. They're gaining 2 or 3% in the pre-market today. In terms of what's going on in Asia, that's where a lot of the optimism has come through. You had a gain on the broader MSCI Asia Pacific Index. Also, the Hang Seng closed up 0.75%, and the Nikkei up a little bit more than 1% on some dovish words from Ueda. That hasn't given any weakness to the yen. It did for a minute see the yen drop, but then the yen has after that strengthened against the U.S. dollar. Here you see the dollar can now buy 133.09 yen. Anna, what do you see in Europe?
Yeah, plenty of conversations through the Asia session then about what UADA means at the BOJ, and the market's reacting to that. Here in Europe then, Matt, we see positivity in the main across European equity markets. Of course, we've been closed for the last couple of global work days, if you like, Friday and into Monday. So a first time to react to some of the data that we got out for the United States on Friday today for European equity markets. The IBEX weighed down by Iberdrola, a substantial weight to the downside on that particular market today. But here's what we see at the upside. Basic resources, the mining sector, the best performing sector across Europe today, and really underscoring the risk-on mood that we're seeing here for European stocks, up by 2.8% today. Here's a chip-making business in Europe, and despite the fact that this business actually downgraded its expectations for what it thinks it can deliver, and some analysts followed suit, some analysts flagged that that had been well foreseen, and the risk-on mood seems to be overtaking those individual concerns. And Soitec up by 7.7%, along with the rest of the chip-making sector. The pound is at 124.43, so up by 0.5%. Weakness in the dollar, really, perhaps the story here, because we see the pound gaining. We also see the euro gaining. But interesting that we are seeing traders increasingly betting on higher rates from the Bank of England, now up to 4.7% or so by the month of September, I think, in terms of their estimates. And the German two-year yield, I put in here the German two-year, but I could have picked almost any contract across Europe to show you the difference we're seeing here in Europe versus the United States. So here in Europe, we are seeing yields on the rise at the short end and the longer end across all kinds of geographies in Europe, and this because of a day's catch-up, because we were closed yesterday, so the market's having their first chance to react to what we saw on payrolls and to everything else we missed out on over the last couple of days, Matt.
All right, well, one of the things we haven't missed out on is the rally in Bitcoin. We've been watching it very closely. Take a look at the token right now, trading above $30,000 for the first time since June of last year. Bloomberg senior crypto reporter Ana Herrera joins us now to talk about this. So, Ana, what's behind the rally? What does this say about, or if anything, what's going on in the industry?
I guess what's really surprising for anyone who's watching, like a casual observer, because the industry keeps having crises and like funding for startups hasn't gone up, but at the same time the price is rallying more than any other asset class, and partly I guess this is because, again, this is a play against sort of inflation and the idea that perhaps interest rate hikes are over. So people are betting against that, and so perhaps that's the reason, but you never know with Bitcoin, obviously.
Okay, yeah, you never know for sure, but it could be linked into the Fed conversation, as you point out then, Anna. Before we saw this resurgence in Bitcoin, we were talking a lot about a year-long crypto winter and a market downturn, and that has meant that some people have been having to support their businesses in the crypto space, and I'm thinking here of the Winklevoss twins. What do we make of the latest moves here?
Yeah, they had to lend $100 million. We had a scoop. They had to lend $100 million to their own platform, Gemini, which of course was embroiled in a lot of the crisis last year. They were one of the partners of Genesis, which went bankrupt, and so they had to come in, and we heard that they had been trying to raise but weren't able to, and that kind of speaks to what I was saying before, the fact that startups have been struggling to raise, and VC, I think, funding is down 80% in crypto, which is a lot. So there's a big contrast between Bitcoin's price and the industry's sort of sentiment. But of course, as we always say, you know, Bitcoin supporters will say one thing is Bitcoin and the rest is the industry, and Bitcoin is its own thing.
All right, Ana, thanks very much. Ana Herrera talking to us about crypto. You can catch our program that focuses on crypto today at 1 p.m. New York time, 6 p.m. in London. Bloomberg Crypto is our weekly show that covers the people, transactions, and technology shaping the world of decentralized finance. And our guest today includes Fred Thiel, the CEO of Marathon Digital, the crypto miner. Let's get to some geopolitical news. The Pentagon says leaked documents that detail U.S. spying on other countries pose a risk to our national security. The Pentagon is conducting a damage assessment. Meanwhile, the Justice Department is trying to figure out who leaked those documents. Joining us to discuss is Mark Champion, Bloomberg senior reporter for international affairs. And Mark, the U.S. leak seems to have rattled both the Pentagon and Ukraine with some obviously very sensitive information, but some of it looks doctored. So how do we know what we can trust?
Well, we don't know exactly what we can trust. I think in sort of order of priority, the first thing is it's sensitive just because there were leaks that seem to show that the U.S. is spying on allies, something that, is known, but generally kept sort of, below the radar. As soon as that becomes a diplomatic issue, it is a diplomatic issue. So that is an immediate problem. A second one is that we don't know exactly whether this is the extent of the leak or whether there is more to come. And this can be quite mischievous if generally accurate documents are then doctored, because it becomes very difficult to sort of fight that in the Twitter sphere, on social media, and to sort of control damage. And the last thing is what was in them, and that was sort of specific to the Ukraine conflict, and it really gave confirmation, if you like, or appeared to the Pentagon's concerns that the Ukrainians may be running out of anti-aircraft weaponry, which would be an absolutely critical issue for the war.
Yes, so that's the Ukraine side and what the leaks said or might have said about that subject. At the same time then, Mark, we are seeing that the US and Philippines are holding their biggest joint military exercises in decades, just after China held a mock invasion of Taiwan. Are we seeing some kind of escalation here?
Yes, I mean, it's these things are very hard to, to interpret exactly. But there's, no denying that, one of the things that the U.S. has done with the Philippines that the Chinese will be concerned about is that there are some new bases that the Americans would be able to use, which would be closer to Taiwan. And what the Chinese were trying to demonstrate with their effort was to show that, it would be very, very difficult for the U.S. to counter a Chinese effort to isolate Taiwan militarily. So this is, will be looked at as a kind of response, an indication that the U.S. does have some of the facilities that would be needed to do that, or more than that it did have before. So in a sense, yes, it does. And I think what we have to bear in mind is that the lesson of the war in Ukraine is that conflicts that seem irrational, and unlikely can take place. And the more that you see these kinds of exercises, the more that there will be reason for concern.
Mark, thanks very much. Bloomberg's Mark Champion with the latest on those geopolitical developments. Let's get back to the markets. New York Fed President John Williams is rejecting the idea that the Fed's rapid interest rate hikes led to problems in the banking industry. Let's bring in our markets reporter, Valerie Teitel. Valerie, what were the major takeaways then from this speech from Williams?
Look, Anna, this is now the third Fed member who is mentioning that they're not swayed by the recent banking crisis when it comes to hiking rates. He said this late yesterday that he personally doesn't think it was the case that the pace of rate increases was really behind those banking issues. He instead called them idiosyncratic, specific issues when it comes to the problems with Silicon Valley Bank and Signature Bank. He then went on to talk about credit conditions. He said, we have not yet seen any clear signs of credit conditions tightening. When he's talking about this, he's saying it is yet to show up in that hard data like consumer spending and employment, but it is starting to show up somewhat in the softer survey data. This is from the New York Fed research team. It was released late last night, showing that the share of households reporting that credit conditions are harder to obtain versus a year ago hit a peak. This is the highest this has ever been. The survey has been taking place in the 10-year history, but nearly 60% of households are saying that the access to credit has deteriorated from a year ago.
That's a credit crunch. Listen, data from last week showed Federal Home Loan Bank issuance plunged. Does that mean the dash for cash is over for U.S. banks and maybe the concerns have subsided now?
Look, it's a big hint that it might be the case for now. The issuance last week fell to $37 billion. That comes after just 2 weeks ago, an issuance of $304 billion, which was a record for the FHLB. These are early signs that the rush for cash is easing. We actually saw in the Fed's data from Friday that the cash reserves that small U.S. banks buffered within those deposit outflows eased somewhat. They released some of that cash from their balance sheet. This is again another hint that these small banks are less worried about deposit flow extending.
All right, Valerie, thanks very much. Bloomberg's Valerie Titel talking to us about the latest Fed speak and what we can take out of the FHLB data that we got yesterday. Let's take a look at some of the stocks that we expect to move in the market today. Weight Watchers International is one that's up almost 18% in the pre-market. It was raised to a buy at Goldman Sachs after completing its purchase of Sequence, which is a subscription telehealth platform offering access to healthcare providers specializing in chronic weight management. That's a long description, so hopefully they can change that to sound better for marketing purposes. Take a look at some of the crypto stocks moving today. No matter what kind of news you've got out, and you can add to this Block and Coinbase, even if you had bad earnings or analysts downgraded your stock, they're still up today because of the jump in Bitcoin, over $30,000 again for the first time since last June in 2022. So Riot, Marathon, and Bit Digital, all gainers today, and we're going to talk to the CEO of Marathon Holdings on our Bloomberg Crypto program at 1 p.m. today. And then Tilray is falling after the Canadian cannabis producer reported net revenue that missed the average analyst estimate, and it's not great, right? Because weed sales were already expected to drop below what they were last year, and then the actual printed number was even worse than that. They make more money on distribution as well as beverages and other kind of wellness things, but this is no bueno for Tilray Brands, and as a result, the stock is down 7.3% in the pre-market. Anna?
Coming up on the program then, Matt, we'll get back to the macro. We'll talk about where the economy is going from here. Simon French joins us, chief economist at Panmure Gordon. We'll get his take on the US and the UK perhaps. And we'll also speak to Tatiana Grell-Castro, co-head of public markets at Muzinich. What is she thinking about real estate, commercial real estate in particular, and what is the outlook for broader credit markets? This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg Surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point. Is this basically just whack-a-mole?
Inflation in Focus, Wednesday on Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York alongside Anna Edwards in London, and we're looking once again at the volatility in bond markets. That's the white line here compared to the lack thereof in stock markets, or at least the perceived lack of volatility for those old enough to continue looking at the VIX. It's the MOVE index that I think is the more interesting. The bond market volatility shot up during the SVB and Signature Bank crises, and has now come back down by about a quarter, but is still relatively high. In fact, still holding at the same levels that we saw essentially in March of 2020. Joining us now is Bloomberg credit reporter Priscilla Azevedo Rocha to talk to us about this volatility and what's causing it, Priscilla, and will it come back down?
Hi, Matt. What is causing this volatility is this perception. The funding markets, they're getting distressed, even if there is nothing like fundamentally wrong with markets per se. Is that during COVID, a lot of companies had a lot of government support, they kept afloat. And now, since with the withdrawal of the support, then the maturity wall of many of those companies' bonds coming to an end, they're starting to feel the distress.
Yes, and certainly in Europe, we might see that with European businesses issuing debt that was then bought up by the ECB due times of crisis, and now they're not the buyer anymore. So is the market open for everyone then, Priscilla, or are investors just much more discerning now?
So the market as a whole is open, but investors have become way more discerning. So now issuing debt has become way more expensive than it was only a few months ago, especially after the banking crisis. Companies and public sector issuers, they still have a lot of access to funding markets, albeit at higher prices, but banks have mostly been absent since the terrible March that we had.
And so if banks are absent, what does that mean for the economy?
That means that getting access to funding is becoming more and more expensive. If banks have less lines of credit in bond markets, it means that they can raise less money. Therefore, when that decreases, that shrinks their own lending activities. So for the general retail corporates, it becomes harder to access funding.
So if the banks can't raise, they can't then offer good rates to others.
Yeah,
okay,
that's
Priscilla,
right.
Thank you very much. Bloomberg's Priscilla Azevedo Rocha with the latest on the credit markets. For more market analysis on credit and much more beyond, check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. A fifth person has died in the shooting at a bank in Louisville, Kentucky. The attack was blamed on a 25-year-old employee of the bank who was killed in a shootout with police. Police say the shooter was live streaming during the attack. In North Korea, Kim Jong-un has called for what were described as practical and offensive war capabilities. That came as Pyongyang cut off communication links with South Korea used to reduce tensions on their border. This year, North Korea has tested new weapons and systems to deliver nuclear strikes against the U.S., South Korea, and Japan. In England, the state-run health service is bracing for its most disruptive strike yet. Tens of thousands of junior doctors walked off the job today for 96 hours. They're joining other public sector workers who are demanding bigger pay hikes to make up for inflation. And Warren Buffett is turning his focus back to Japan. Berkshire Hathaway has kicked off a yen bond sale, and Buffett told Nikkei he plans to boost his investment in the country. Shares of Japan's major trading houses jumped after Buffett said he's raised his holdings in them. Meanwhile, in Switzerland, Parliament will question the government today about its role in forcing through UBS's takeover of Credit Suisse. The government agreed to provide up to $120 billion in taxpayer money to support the deal. Lawmakers may be unhappy, but authorities say there's not really much they can do to stop the takeover. And in Sweden, Electa's CEO is forced to step down after Sweden's biggest pension fund became one of the largest overseas casualties of the meltdown at U.S. banks. And this pension fund, Electa, invested in Silicon Valley Bank as well as Signature Bank and First Republic. Quite a ways from home and some pretty risky, it turns out, in hindsight, investments.
Yes, quite away from home is an interesting point to mention there, because I understand that they put the equity portfolio manager on leave, and they said they would scale back large stakes in companies, quote, far away from home. So that would be an interesting outcome if this leads to more home bias when it comes to investment strategy. We'll talk about macro assumptions, though. Simon French joins us shortly, chief economist at Panmure Gordon. We'll talk about his outlook for the U.S. economy and here in Europe. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Bitcoin goes over $30,000 for the first time since June. It's now up more than 80% this year. The Pentagon warns that those leaked intelligence documents are a threat to security. Prosecutors want to find out who is responsible. And there's an early sign that the banking crisis in the United States has started to subside. Meanwhile, New York Fed President John Williams says the central bank's rapid interest rate hikes didn't cause the recent turmoil. I'm Anna Edwards in London with Matt Miller in New York. And Matt, the focus for markets in terms of data last week was on jobs. This week is going to be around inflation in the United States. But we're playing catch up here in Europe. I see U.S. futures point a little higher this morning.
Yeah, U.S. futures, I think, are buoyed somewhat by the positive finish that we had in Asia overnight. Take a look at what's going on right now, about 0.25% after we closed just slightly higher on the S&P 500 in the cash trade yesterday. Also getting a little bit of a tailwind from lower rates really across the curve. We saw the 2-year come down below 4%. The 10-year yield is down below 340 right now at 338.87. So this offers less competition to stocks. And you don't really see a big surge in commodities. We may have worried a week ago that we would see oil taking off after the surprise cut by OPEC+, but it really hasn't moved much after the $5 gain that it got, both in terms of WTI and Brent. Right now at $80.34, just up about 0.75%. We do see Bitcoin moving up over $30,000. It continues to rise ever since the drop in the wake of the FTX collapse, but it's much higher now than the $16,000 it was trading at the day before Sam Bankman-Fried's firm failed. Right now at $30,085. That's the highest we've seen it since June of last year. In terms of pre-market movers, there is actually a lot going on. Weight Watchers was raised to a buy at Goldman Sachs after completing its purchase of Sequence. You've got a ton of, well, let's say all of the blockchain-related or crypto-related stocks gaining. Marathon Digital is one we highlighted here, up 3.5%, because we're going to be interviewing the CEO on the Bloomberg Crypto program today. Fred Thiel joins us. Tilray Brands is the weed seller out of Canada that missed its revenue estimates, the street's revenue estimates, I should say, and actually saw a decline in sales year over year. What's going on out there? That's the weed portion of it. They also have a big amount of revenue, even bigger, from distribution, and then some from beverages and some from other wellness issues. But It's down 7% in the pre-market, and Newmont Mining is down a little bit more than 2% right now. Even as gold rises, the U.S. producer has made a fresh bid for its Australian rival, Newcrest Mining, sweetening its record offer to $19.5 billion to bring closer the prospect of a precious metal behemoth. Is it behemoth? How do you say it in England? Behemoth?
I don't know. I just never say that word. Giant is how I say it.
I gotcha.
Matt.
I gotcha.
If in doubt, find an alternative. Stocks Europe 600 up by 0.6%. Interesting what you were saying there about the mining stocks, though, and the M&A you're seeing there, because that caused one stock to move in the opposite direction to others in the mining space there, Matt. We've got basic resource stocks up by 2.7% today, just underscoring the risk-on mood that we seem to be in as we return from an extended weekend here in Europe. So after a couple of days out from trading, where other global markets may have or may not have been open, we play catch-up here in Europe, and we're up by 2.7% on mining stocks and up broadly around stocks as well. The pound is at 124.44, up 0.5% against the dollar. Maybe it's dollar weakness more broadly that we're talking about here, though, because the euro is also stronger. Interesting that the market is increasingly pushing higher expectations of where rates go here in the UK, with that inflation rate still running double digits. The German two-year yield I put in here just to show you the catch-up story that's happening in bond markets, because Treasury's moving in one direction, bond markets in Europe moving in a different direction, and we see those yields going higher here in Europe. We're playing catch-up because, of course, this is the first time that European equity markets, or sorry, bond markets, get to react to that jobs report that we saw out during Friday's session, Matt.
All right, let's talk about the macroeconomic picture right now with Simon French. He's the chief economist at Panmure Gordon. And Simon, I think it's interesting that today we're seeing continued dollar weakness as consensus seems to be pulled forward on a U.S. recession, maybe a global recession, and then strength in gold over $2,000, strength in Bitcoin over $30,000. What do you make of the way the market is pricing these assets?
Well, I'm liking the fact that you pick up the gold market story. I think that's an area where, look, the headlines on banking fallout, real estate fallout have waxed and then waned, but we expect them to wax again. And in that environment, gold is telling you, and I think it's the right investment hedge in that scenario, that this is not going to be the immaculate deflation story that we had at the very start of Q1. There are going to be failures in both the banking sphere, the real estate sphere, and as a suite of assets across the global economy reprice themselves to a risk-free rate that looks very different. So I think the market is trying to tell you that. It never tells you these things in a straight line, in a linear fashion, but there are enough indications within there that this is not going to be a gradual recovery to something looking like normal.
Yes, so, very good to see you, Simon. And I want to understand what normal will look like when we see a little more of a settled picture when it comes to global interest rates and global inflation. The IMF talking about how the neutral rate might fall back down to these really low levels of rates that we saw over decades that we knew and loved, perhaps, or didn't, depending on positioning. But that was a story that maybe some economists think we've left behind. So what's the debate there?
Well, the IMF blog that you're referring to, this is talking about the natural rate of interest that has been driven lower by demographic change around the world, and quite clear in the IMF analysis is that the two fastest growing major economies, China and India, are going to see the same pathway over the next 2 to 3 decades that the developed markets have seen in the last 2 to 3 decades. And that is interesting from a fixed income perspective. I'm not sure it feeds a lot into the current debate over where the risk-free rate goes from here. But to the opening part of your question, what does normal look like? Well, I think if we'd been having this conversation of how the economy, the global economy, would respond to higher risk-free rates, if we were having it 12 months ago, we'd say, well, the labor market will weaken. That will be the stated objective of central banks. Is the interpretation, it's certainly my interpretation 12 months on, that actually labor markets are far more resilient to a higher risk-free rate than we thought. And actually, when we're talking about demand destruction, it's principally through capital and the allocation of capital and the repricing of capital, rather than actually the challenges in terms of labor demand from employers.
Okay, so that's the way that the labor market has maybe been resilient. Do you see cracks emerging? We had an interesting story out this morning in a UK context that talked about a sort of very monetarist economic approach, I suppose, and looking at the money supply, and certain economists flagging this as really worrying, saying we've gone too far. Look at the way that the money supply has fallen off a cliff, and that really tells you that something bad is looming. Where do you stand on that kind of debate at the moment for the UK?
Yeah, well, the first thing to say is give the monetarist economists who've been under a lot of pressure for 2 or 3 decades, give them their credit, because they flagged the ignorance or the ignoring of monetary aggregates among central banks during the COVID recovery as a real red flag that inflation was coming. And that was largely dismissed by the new Keynesians who tend to dominate central banks, and indeed the independent economics community, and I put my hand up in that regard. They got it right on the way up. The question is, of course, for an investor to be valuable, for this insight to be valuable, it's got to be right on the way down. And they are right to say the monetary aggregates really around the world are now slowing at a very rapid rate, and there's a fear of an undershoot in terms of inflation. I don't actually see that, even though the monetary aggregates are pointing in that direction. Why? Because there's quite a lot of pent-up pricing pass-through. It's quite a mouthful to come out with at this time. That's still to come through in the wages story that I think will mean that inflation will remain quite persistent, even as those monetary aggregates start to come back towards low single digits.
So, Simon, you don't expect us to get back to ZERP or NERP in the next few years?
No, I don't. And this is where that IMF blog has, if you like, triggered that debate again. It's talked about the fact that these structural forces from demographics, from financial intermediation, lots of debt dynamics as well, distribution dynamics, are pointing towards closer to ZERP. But we have to get there, and that's the key part of getting there. The narrative adjusts almost instantaneously. A lot of prices in capital markets adjust almost instantaneously. The economy doesn't operate like that. Bargaining doesn't operate like that. And in my view, the bargaining between workers and employers still has a lot of flux still to come through.
Yeah, and watching that, the labour market developments then seem to still be key. Simon, thank you very much. Simon French of Panmure Gordon joining us to talk about the global economy. Coming up, we'll talk about global credit. Tatiana Grail-Castro joins us, co-head of public markets at Muzinich & Co. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, almost $1.5 trillion of U.S. commercial real estate debt comes due for repayment before the end of 2025. And the big question facing those borrowers is who's going to lend to them? And I guess the follow-on is at what rate? Joining us now to discuss is Bloomberg's Simone Foxman. So what exactly does this wall of debt look like? I'm assuming the rates are so much lower on this than they will be on any debt that's rolled over.
Absolutely. So this is the result of a calculation by Morgan Stanley's James Egan, who points out that there are $4.5 trillion worth of commercial real estate debt, and about $1.5 trillion of that is due before the end of 2025. Especially poor sentiment in things like retail and offices, where he expects the valuation likely to fall about 40% from peak. But this is disproportionately held by regional lenders who've seen their own cost of funding rise 50 to 60 basis points just in March alone. So then the question becomes, if they can't lend to this commercial real estate issuers, who will? Potentially private credit, but of course, at what rate? That remains to be determined.
So if smaller banks then, Simone, have pushed into this commercial real estate lending space, how much of a concern is the recent bank stress that we've seen very much focused around those smaller banks?
Well, you know, this regional bank stress really serves to exacerbate an existing problem. Back in January, before we saw all these concerns with Silicon Valley Bank, et cetera, there was $175 billion of commercial real estate trading at distressed levels. And part of this is because we've seen the sentiment around commercial real estate change. You know, we saw people stuck at home during COVID-19. They bought more stuff online. They increasingly don't want to go back to the office. And Cushman & Wakefield believes that we could see 330 million square feet of excess office space in the U.S. alone, these problems also spreading to Europe. Now, the good news is that after the global financial crisis, less of the bad debt anyway, is going to be held by banks. But then again, you know, how much of this is held by family offices? That's something Ben Emmons at New Edge points out. And of course, you know, if these commercial real estate issuers struggle, then that has knock-on effects on jobs, on the global economy.
All right, Simone, thanks very much. Simone Foxman coming in to do that report for us. We're going to be talking about this issue certainly for months to come. Joining us now is Tatiana Grail Castro, co-head of public markets at Muzinich. And Tatiana, you know, how much of this issue, you know, the bigger issue that so much debt needs to be rolled over from, you know, near zero interest rates to, you know, 6 or 7 or 8 or 9%, how much of that is a concern to you?
It is a concern, and I think the other thing that we need to point out here is actually we have to look at it quite differentiated. So yes, it is a concern, and it is a concern in the US for different reasons than it is a concern in Europe. I think that's something that also needs to be highlighted. So in the US, as you pointed out, regional banks are big lenders, CMBS, so structured credit are big lenders. In Europe, it is actually the dynamic has been quite different over the last few years. So since 2016, roughly, more and more real estate companies came to the capital markets to fund themselves. So that means that they didn't have to offer security many times. They also issued PERPs. So it's a completely different borrowing structure in the US and in Europe, but both sides have issues. So, and it's all about refinancing and how the refinancing will take place. And some of the solutions will depend on who the borrower is today to see what financing solutions we can find going forward.
In terms of central bank, the role that central banks play, obviously bringing rates up so high so quickly. Do you see the possibility of a pause or a turnaround now? A pivot?
So yes, for us, we see that, clearly last year rates were a headwind, both because they went higher, but also because of the very high volatility. It's very difficult to price credit if interest rates are so volatile. We now see rates having broadly found a band. So yes, there could still be volatility within that band, but we definitely see that pretty much the rate rises are behind us. Yes, marginally, we may see another 25 or 50, but it's broadly behind us. And then clearly the next is, will there be rate cuts as early as this year? But we see that there could be a potential now from rates turning from headwinds into tailwinds with maybe some volatility. And really it is credit risk. Real estate would be one sector that is quite exposed to credit risk. But more broadly, we see credit risk to be the one that we have to really pay a lot of attention to.
Yeah, Tatiana, good morning. We heard from our credit reporter earlier on that capital markets are open to companies that want to borrow, but they're much more discerning than maybe they were when rates were a lot lower. So which of the companies and the types of businesses that you see running into difficulties, especially as you were describing the way that European real estate businesses have relied much more on those capital markets to fund themselves?
Yes, exactly. So the focus is always very much on U.S. real estate and commercial real estate and their connection with the banks. In Europe, we definitely need to add to that the sort of the capital markets. So our capital markets open for them. And that is also the case more broadly. So we talk about financial market conditioning tightening with regards to bank lending standards, but we also see capital markets to be far more discerning, as you say, and as it was explained previously. So where we definitely see, especially the weaker rated businesses, already last year there was a huge decline in the issuance within high yield loans. And we continue to see that. That hasn't really properly reopened in 2023 either. And to the extent that maturities are coming up, and we're not talking 23, 24, but 25 maturities. And those companies really need a long window to refinance so that the macroeconomy is there for them to refinance, their own earnings profile is there for them to refinance. So it is really the weaker rated companies, the more highly levered companies. The company came with huge EBITDA adjustments that never really started to materialize those higher EBDAs that that they had promised investors. And then clearly also certain sectors in real estate would be one.
Tatiana, thank you very much. Thanks for the analysis. Tatiana Grell-Castro joining us there from Muzinich. Coming up on the programme, Biden heads to Belfast to mark 25 years since the Good Friday Agreement. More on the US president's trip next. This is Bloomberg.
is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. US President Joe Biden arrives in Belfast in Northern Ireland tonight. He'll be there to mark the 25th anniversary of the Good Friday Agreement. Bloomberg's Louise Moon filed this report on the history of the accord.
"25 years ago, politicians in Belfast signed the Good Friday Agreement, officially ending more than 30 years of conflict in Northern Ireland. Known as the Troubles, around 3,500 people were killed in violence including bombings and rioting. The prospect of peace and a stable, devolved government was met with overwhelming support. Tony Blair, Bertie Ahern and Bill Clinton played a key role in helping hammer out the agreement. It was based on power sharing between mostly Catholic nationalists who favoured independence and Protestant unionists wanting to preserve ties with the UK. But the journey hasn't always been smooth, and distrust remains, along with continued instances of violence.
We are dealing with a divided society. We wish it wasn't, but it is. And, you know, it's going to need tender and open care for a long time.
The Northern Ireland Assembly at Stormont has been unable to function for 40% of its lifespan due to disagreements between the sides. Most recently, the Executive Committee hasn't met since February 2022, discourse spurred in part by post-Brexit trading arrangements. While not suspended, no major decisions can be made. But despite many continuing challenges, optimism remains.
Whatever the problems in Northern Ireland, what people should never forget, it's a world better from where it was. And if we exercise common sense and realism today, we can keep the peace intact.
And so, Matt, we wait for President Biden to arrive in Northern Ireland, and then he's also going to be going to the Republic of Ireland. And Biden will be the 8th sitting US president to visit Ireland. It's a thing that many presidents choose to do.
I wonder, the main question for me is, where does the border go, right? If you're not going to put it in the North Sea, do you put a border between Ireland and the Republic of Ireland, and wouldn't that cause problems?
Well, the Windsor Framework is supposed to be this big compromise that has played out politically pretty well for Rishi Sunak, although it hasn't got power sharing back in place in Northern Ireland. So that's going to be a big focus whilst President Biden is in the area, thinking about how the policy-making machine, if you like, actually functions in Northern Ireland. It was set in place with great fanfare 25 years ago, but is it actually working on the ground will be something that will be much discussed, I'm sure. That is it for Early Edition. Surveillance is ahead. They'll be hearing from John Bolton, former US National Security Advisor, among others. This is Bloomberg.
biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
This is Bloomberg.
It's incredible how quickly the lending market is shutting down, and we're worried about whether the Fed's going to raise rates 25 basis points.
From the Fed's perspective, their primary concern is this wage price spiral.
We've been calling for a tighter Fed. That tighter monetary conditions will surprise you some way, shape, or form.
I still think you're going to go into a second half recession, but not all recessions are created equal.
I'm somebody who I think thinks we're going to find it hard to get back to 2%, right? I think that is really going to be where the rubber hits the road.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from the nation's capital for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. With a bit of a secret, Bramo is going to make a return potentially tomorrow. So looking forward to her joining us right down here in Washington, D.C. Futures right now on the S&P 500, positive about 0.25% on the S&P. TK, we've got a big decision to make. Which one is it? Citigroup economists say that the banking stress is contained. Apollo's Torsten Slok says the credit crunch has started. Now, they are two very different conclusions.
I totally agree. In the zeitgeist this morning, that is the singular question. It's possible it could push aside the meetings of the IMF and World Bank. I'm not there yet, John. Anthony Feld and Ira Jersey, publishing for Bloomberg Intelligence, use the word accelerate. What's happening in the short-term paper market is accelerating right now.
We've got a big division, a divergence, a spread, whatever, pick your word if you will, between what the Fed is projecting and what the market is pricing. We've talked about that a lot on this program. John Williams of the New York Fed, not worried about it at all. He was speaking to NYU yesterday, and he said time will tell. That's just not on his radar, seemingly in the way that we thought it was.
I was surprised by that, and it's who he is as well. He's a great theorist. He's a great economist out of San Francisco, over to the New York Fed, the gentleman that maybe codified R-starred, which is also it'll be a big theme here this week. But yes, I was surprised by what John Williams said, pushing it away. Most people disagree.
Also, some controversial comments about the speed at which they tightened and shaking off any potential blame about what's happened with two banks in the United States.
What's so important here, John, is raising rates. Now what? And what I hear, I mentioned this yesterday, pause. Those kind of choices that have to be made along the way by us and also by the ECB as well. He pushed it away.
The question's changed, though, Tom. A few months ago, it was about how far are we going to hike. Now it's about what are we going to reduce rates to? How far will we cut back? The IMF started this week, TK, by saying, and I think making some headlines, and we'll be talking about it through this week at the IMF meetings at their headquarters later on this week, Tom. They're making the point that rates can go back to pre-pandemic levels. I've heard a ton of pushback against that.
Rich Miller, writing for Bloomberg today, just says it's real simple. Can you consider Professor Summers of Harvard, or can you consider Professor Gopinath at the IMF? And there are two wide debates here. What I would suggest is you say the consensus into these meetings is to push back against the grimness of the IMF and the World Bank as well.
That's going to be the debate down here in Washington. We'll revisit that debate in just a moment. I want to pick up on the price action and start with equity futures on the S&P 500. If you are just tuning in, welcome to the program. We are just about positive by 12 points on the S&P, up around about 1/3%. Yields back in by a couple of basis points. No drama here on a 10-year, 339. On a 2-year, Tom, down 2 basis points. Just sub 4% here at 398.
The drama, John, is the 3-month as compared to the 10-year, and here's the key phrase. We've never been here. Never. Rarely do I say that, but you really go back decades and decades and decades, and to see the 3-month on radio, it's simple. My hand's way up high, and the 10 years way down here, and that is the tension point into this Tuesday morning.
And you can see the cuts that are starting to come through the front end of the curve outside of T-bills, which of course are just tracking where Fed funds are. If you think about where the 2-year is, just going out a little bit further down the curve, Tom, we've gone from north of 5%, was it, to south of 4%, just like that, in a month or so.
Just like that, but
quickly.
On the BTMM screen, there's still a lot of 5% tension. It's out there, and that goes to the banking, to bring it full circle to how we opened, John, that goes to the banking crisis, and what are we going to see there? And some of those charts are pretty fragile right now.
Joining us right now is Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Pete, great to catch up with you and good to have you with us on the program as always.
Thanks,
Can we start with the question that Tom and I were exploring? Citigroup economists say banking stress contained. Apollo's Thorsten Slog says the credit crunch has started. Is it one or the other, Pete, for you?
Well, it is, I think, a little bit of both. I mean, the banking crisis has been contained, given that there's good access to liquidity, and the strongest banks, both in the US and in Europe, have very strong capital positions, so nothing like the situation we were seeing during the financial crisis. But nonetheless, particularly in the US, you are seeing a big pullback in bank lending, particularly in mid and small size regional banks, and that is going to have an effect of tightening financial conditions for a large part of the economy, given that smaller companies rely disproportionately on loans from that part of the economy. So I think the big question is what spillover this really has to the real economy, and does it avoid a recession? Our view is it does, but I think the market, to Tom's point, is very much already pricing in a soft landing and quite a lot of optimism. Remember, the first quarter, the US was up 7%, the strongest we've seen at the beginning of any year since 2019. So I think there are still risks for the market.
And Peter, also pricing in some profit headwinds to the financials as well. That was a sector, Peter, that for a long time you've advocated for. We saw that big move off the bottom last summer in European banks. You were talking up that sector for a long time. What are you advocating for now, given the developments of the last month?
Well, in Europe's case in particular, and we've been overweight of Europe and still think that non-US markets offer better value, and they're generally doing better, and I think that can continue. We like the banks in Europe. We like the deep value sectors, banks, resources, and oil sector. They all had a fantastic year last year as rates rose and the fundamentals improved for them. They've had a very difficult start to the year, but they remain very cheap. On a relative basis, they're as cheap as they've been at any point since the financial crisis, if not cheaper, and the fundamentals are a lot better. We've been pitching that against the kind of barbell of having also a focus on what we call the granolas, the big defensive 11 companies that dominate the index. They make up about a quarter of the European index. And we like in the US as well, strong balance sheet, stable margin businesses, which again are quite dominant in the index. And I think that's one of the reasons why at the index level, things have been holding up quite well. The biggest companies are quite defensive.
Peter, help me here with the banks. In Europe, I've got banks with very substantial dividends and maybe subpar dividend growth. Over in America, maybe I've got some growth in banks, but what I have is shattered banks. What does Goldman Sachs do in owning banks now and also in the partition of what to buy?
Well, again, the focus I think we have in banks globally is more in Europe. You've got very strong balance sheets and a very heavily regulated system. 1.8 trillion in excess reserves, tier one capital of 15.5% compared to 5% a decade ago. I think they're reasonably robust given the valuation. Now, in the case of the US, it's a much more mixed picture because you have a two-tier regulatory system, and the regional banks are pulling back. They're having to pay more in deposits. That's going to hit, I think, their revenues. So I think you have to be much more selective if you're going to take exposure to the financial sector there.
Is the financial crisis over? Excuse me, is the banking crisis over? This is a big debate this morning in the zeitgeist in America. From your view from London, are we all clear of the trauma of 6 weeks ago?
I don't think we're all clear in the sense that we have to recognize we've seen a massive change in the cost of capital after 10 years of seeing interest rates at or around zero, in some cases below. The shift that we've seen over the last year is dramatic. And as you said, at the short end, you can still get close to 5% risk-free, zero volatility in US cash. That's a very high hurdle for many assets to beat. And inevitably, with the fastest rise in interest rates, not highest level, but fastest rise we've seen since around 1900, I think there will be other negative fallouts from that. And where that occurs is yet to be seen. Obviously, there's a lot of focus on commercial real estate and other areas of leverage, but I think there will be other fallouts from this. I think it will be less systemic because in the end, the private sector in aggregate has healthier balance sheets and therefore is better able to absorb shocks like that than we were seeing, for example, a decade ago. But I think there'll be more ramifications from this shift in rates that we've seen.
Hey, Peter, wonderful to catch up and get your perspective as always. Peter Oppenheimer there of Goldman Sachs on the latest in the financial sector and for equities as well. Michael Hartnett of Bank of America puts out a weekly note, the Flow Show. And in the Flow Show, in this week's weekly note, Tom, he said, sell the last rate hike of the Federal Reserve. Sell the last rate hike.
That's been out there. There's a history to that. I don't diminish that at all. The question is, when's the last rate hike? And we need to make clear there's a select group of guests that say it's not over with one more rate hike. I mean, there's a very substantial crew that says wait for the data to turn, and it's plain and simple. It hasn't turned. We're still seeing inflation, and I believe we have an inflation report this week that may be more important than the IMF meetings.
The CPI coming up tomorrow, Tom. There are some people who think the last hike was the final hike of the hiking cycle.
Oh,
That's a big divide right now. I'm with you. Let's talk about the calendar. So CPI comes up tomorrow. We've talked a lot about the financials and the banks. They report later this week. It really kicks off with JP Morgan, Tom, on Friday. I spoke to a couple of guests yesterday, was talking to them, both on the record on this program and off the record as well on telephone calls. And TK, many people just saying the same thing, is that for them, the financials reporting this week and through next week, just as important, maybe even more important than what they're going to see from CPI or from payrolls last Friday.
On a Tuesday morning, setting up for the IMF and the World Bank and setting up for some great conversations, what we need to state is from Friday to now, there's this new fragility in the short-term paper market that has to be studied very carefully. I mean, it's a really odd moment on a Tuesday morning.
What do you think is going on there, Tom, that you're concerned about? Is there anything actually to be concerned about?
No, I don't think. I have not seen any reporting of scandal or crisis. I think it's a reality of what deposit flows do and, frankly, what the American public does in their choice of where to put 4.8 or 5% money.
This is what Peter Chia of Academy said yesterday. The shift we've seen in deposits, I think we were obsessed with the idea that was about credit risk in the banking sector.
Yeah,
maybe those banks won't be there anymore. He was saying that's about interest. That's about
totally
yield and nothing else right now.
It's decisions made in the kitchen. Do we want to go to JP Morgan? No, but where are we going to go? Money market funds.
Equity futures right now on the S&P 500, positive by around about 1/3% on the S&P. As we've said repeatedly, CPI coming up tomorrow, and then it's on to bank earnings on Friday. We'll be here down in Washington all week for the IMF meetings. From Washington, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Pentagon says those leaked documents that detail U.S. spying on other countries is a risk to security. The papers include an assessment of weakness in Ukraine's military. The Pentagon is conducting a damage assessment. Meanwhile, the Justice Department is trying to find out who leaked the documents. In North Korea, Kim Jong-un has called for what were described as practical and offensive war capabilities. That came as Pyongyang cut off communications links with South Korea used to reduce tensions on their border. This year, North Korea has tested new weapons and systems to deliver nuclear strikes against the U.S., South Korea, and Japan. In England, the state-run health service is bracing for its most disruptive strike yet. Tens of thousands of junior doctors walked off the job today for 96 hours. They're joining other public sector workers who are demanding bigger pay hikes to make up for inflation. New York Fed President John Williams is rejecting the idea that the Fed's rapid interest rate hikes led to the problems in the banking industry. Williams says there were some specific issues with the two banks that failed. The Fed's benchmark rate is in a target range of 4.75% to 5%. That's up from near zero a year ago. U.S. gold giant Newmont has sweetened its bid for Australian rival Newcrest. Newmont is now willing to pay $19.5 billion to close a deal that would create the world's largest gold miner. It would also increase Newmont's exposure to copper. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Wall Street prepares for the latest read on inflation.
The inflation report is going to be very important.
Inflation is slowing, but the Fed has more work to do.
We have this huge disconnect between where the dots are and where the market is.
The Fed's saying one more hike. The market says 100 basis points of cuts.
Instant reaction on Bloomberg Surveillance.
Can you establish disinflationary vectors in goods and services?
And what it means for the Fed.
They're moving data point by data point.
Is this basically just whack-a-mole?
Inflation in Focus, Wednesday on Bloomberg.
Despite the remarkable resilience of consumer spending in the United States, in Europe, despite the uplift from China's reopening, global growth would remain below 3% as we projected it earlier this year. And what is more concerning, it would remain around 3% for the next 5 years.
Pretty gloomy stuff from the International Monetary Fund Managing Director as we kick off IMF week here in Washington, D.C. From Washington this morning, good morning to you all. Your equity market shaping up as follows on the S&P 500. Futures look a little something like this, positive by 0.28% on the S&P, a lift, but still, this range sticks. 3,800 to 4,200 on the S&P for the last several months, and we're struggling to break out of it. Spoken to a lot of people, Tom, who have said the same thing. They expect to break out to the downside, with one exception. Anastasia Amoroso of iCapital, to you and I on Friday, who thinks we can break out to the upside here.
And I'm with her in the sense no one else believes it. I think she's pretty lonely in that. There's other people out there that are uber bulls, but I think the headline of the last 4 weeks, John, is how the equity market has been resilient. Granted, it's that time of year. There's a seasonal factor with the retirement plans, tax season, and all that, where you get a little bit of this. But the headline here is SPX 4100.
Then we return to the earnings. Tom, I asked this question yesterday. I'd love your thoughts on it. If the Federal Reserve couldn't change its view on the outlook because it was too soon after the banking failures in the last month, why is the C-suite going to be any different this week? Can they provide any fresh guidance after the developments of the last 30 days or so?
It's a really important question, and I'm going to get guidance from Federal Express in that, like lemmings off a cliff, everybody's going to find some form of restructuring. And what's great here, John, you're not going to remember this, but LTV, I mean, the only one in Washington that remembers Ling Temco vote is Terry Haynes, and that is the conglomerates deconglomeratize, and then after 10 years they come back together and do it again, and then they hire McKinsey and they do it again. I mean, that's a cycle.
Are you saying the only person that gets rich is McKinsey? Is that basically
or Bain or BCG or, I mean, that's when you fly into Washington. Do you see the houses when you fly into Washington?
Not bad,
You come down to Potomac, it's so romantic. The smallest house is 5,000 square feet.
Are you thinking of moving here?
No, the front hallway is bigger than yours and my apartments combined.
Well, it's a very different city.
It's a very different city.
It's a very different city.
So let's bring in our guest here who understands the real estate of Washington, Terry Haynes, founder of Pangea Policy, and he knows that when there's a international scandal, you have to go there. Terry, finally, the Washington Post catches up today with huge layout of secrets given away by our Pentagon. Put it in historical perspective now. How upset is the city over intelligence secrets leaked, including on Egypt? How big a deal is this?
I think it's a big deal. It is not catastrophic. It is a situation where we all understand that we all spy on each other, firstly.
Sure.
Secondly, this sort of document dump hasn't really been done in at least a decade or more. We get about one of these a decade, going all the way back to Pentagon Papers and that sort of business, which was different. Biden's going to have some cleanup work on the aisles with allies, but overall, I say it's not that big a deal because it's not going to shake the foundations of alliances anywhere.
But to politics, it says new technology. John's on Discord like 3 times a week, but the answer is there's a new technology involved that everyone has to adapt to.
Sure.
Do you have a confidence that our defense establishment, the military-industrial complex, will somehow adapt to the new technology, the new internet, the new speed of transmission?
I think they will do so, but they'll do so slowly. There's always a lag time. My suspicion is that what we've had here is a situation where the systems haven't been upgraded for the last several years, and now they're going to be in a crash program.
They're going to do slowly, John, because they're stuck in traffic out by Herndon. I mean, that's really what's going on.
That's what's going on
in Virginia. Yeah, that's why they're doing it slowly.
Okay. Would you like me to get this back on the rails?
That's a Washington angle. Continue.
Okay. I want to talk about Macron and the comments that he made over the weekend in a couple of interviews. Terry, what did you think of them, just to begin?
I thought generally that what the president was doing was trying to both mediate between the United States and China and actually position France in a position to be somewhat between the United States and China. We all talk about the European Union like it's a unitary body, and in fact, of course, it's 27 countries that have very different agendas in very different places. Macron's agenda is to make sure that France has markets, defense and otherwise, and he made that very clear.
Do you think that Europe faces the very real risk of repeating the same mistake it made with Russia?
Yes, I do. absolutely. There's such a thing as mediation. There's such a thing as making sure that you have communications open to both sides. There is also a serious possibility for kind of willful misinformation, willful desire to abandon yourself to the idea that we can deal with China in the same way we can deal with the United States or other countries. I don't think that's so.
What do you think the White House can do about this?
I think what they can do, frankly, is rally the other countries in the European Union and surround Macron, and I suspect they're already doing that with.
So you actually think Macron might be lonely?
Yeah, I do to some extent. Yeah, because to your point, Germany doesn't want to make that same mistake again, and you've got an awful lot of smaller countries that are on the borders, whether they be the Baltics or the Eastern European countries, that are not going to want to make that same mistake. And so what you've got is a situation where, yeah, I do think Macron's going to get surrounded a little bit.
I want to bring it back to domestic, where you're so good, Terry, and measuring the middle ground of Washington. What I see, and it's not so much the event, I see Nashville, rapid response by Democrats against Republicans, the abortion pill debate. And separately on that, I bring this up because one of our staff is down at Disney World as we speak, spending $3,000 a day on tickets. DeSantis and Disney and Orlando. And it seems now there's a new Democratic rapid response to the Trump part of the Republican Party. Is that a sea change in strategy and policy by the Democrats?
I don't think it's a sea change. I think it's a new thing.
It's a new thing.
Yeah, both parties end up doing this. And Republicans seem to be flat on their feet right now, and they'll probably get back and start responding. But you have to remember that what went on in Florida with DeSantis, what goes on in a lot of other places, appeals to a broader base too. But we're to the point now where the kind of the political rapid response is more obvious and more important in some ways than the substance of what's going on, and that's out of whack, certainly.
I mean, I look at this, John, and the speed of responses here, and it's, again, the new technology, the new age we're in.
Who's the winner of the last month for you, Terry? Is it the former president?
Which former president?
Donald Trump.
No, I wouldn't say so. I think that we're watching a very long, slow slide down with Trump, frankly. And I still do that. I still think that.
Within his own party as well? Because we don't see that in the polls.
Yeah, there's a hard nugget of support, but what I think is you see day by day, very slowly, is a situation where the hard nugget still exists, but increasingly people are looking for kind of Trumpism without Trump. And let's remember, too, that a lot of the Trump agenda, including the China agenda, has now gotten adopted largely by both parties. So, people are looking for a candidate without baggage.
Who is that?
Today, it's DeSantis. I mean, DeSantis is, frankly, I think, right where he wants to be. You don't want to be
30 points
there's a guy you'll remember, Tom, and John won't remember, to go back to this, Pat Buchanan. Pat Buchanan was a very young guy working for Richard Nixon. He got all discombobulated because in 1967, George Romney was winning the nomination, and Nixon took him aside and said, "You don't understand. I'm in second place. That's where I want to be today." DeSantis is where he needs to be today.
He's brilliant. George is Mitt's dad.
I'm aware. Terry, thank you.
Thank you, John.
Terry Hanks.
Thank you, Tom.
That was brilliant,
Policy. Just wonderful, as always. Live from Washington this morning. Good morning to you all. Equity futures on the S&P 500 positive by about 0.25%. This is Bloomberg.
we're investing a lot in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in the store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From Washington, good morning to you. Let's check out a price action. Counting it down to the opening bell, about 3 hours away. Equity futures positive by 0.2% on the S&P. On the Nasdaq 100, positive by 1/3%. The Nasdaq, without a doubt, the winner of the year so far, year to date. Into the bond market we go. What a range we've seen in the bond market over the last month or so. We've talked a lot about that on a 2-year. Just short of 4% right now. 3.98, down 2 or 3 basis points on a session. Similar move on a 10-year maturity. That yield is 3.3925. We're down about 2 basis points there. I want to finish on foreign exchange just briefly for you. Euro dollar, the high of the year, 110.33. Do you remember the high of the year? Just after the ECB, before that monster blowout payrolls report in early February. The payrolls report, I believe, was February 3rd. I think February 2nd was the intraday high of the year on euro dollar. Short of that right now at 109.11, but certainly some renewed euro strength over the last several weeks. We're positive on that currency pair, Tom, by about 0.5%.
Yeah, and what's interesting here is there's lots of things buttressed up against resistance or sitting on support is a classic technical thing, John. To me, I'm watching the 10-year real yield 1.11%, and it's sort of there in the last week. But with any kind of news flow, which way does it cut? And that's the mystery just on that one parameter. As you mentioned, euro. There's some real debate. I mean, there's people looking at 120 strong euro, which seems out of the realm of thinking.
I think we're all working through the calendar and continue to do so. We'll keep revisiting that. CPI comes up tomorrow. We'll have full coverage, of course, right here on Bloomberg TV and on Bloomberg Radio. Veronica Clark of Citi expecting inflation to come in a touch higher than others expect. They expect core CPI will rise by 0.5% month on month for a second consecutive month in the month of March, highlighting that core inflation has yet to slow substantially. Further confirmation that core inflation is not yet sustainably slowing down should keep the Fed raising rates again at the May FOMC meeting. And Tom, of course, the call from Citi is that they don't necessarily stop in May. They may well keep going.
Andrew Hollenhorst and Veronica Clark have really reaffirmed that. And I think this is a really important conversation for those of you talking rate cuts. Veronica Clark, of course, at Citigroup. Veronica, not only do you talk about the place of inflation right now, but you say, if anything, you'll be surprised to the upside. What parts of American inflation push us to the upside?
Yeah. When we do our inflation forecast, we really do a very detailed bottoms-up forecast. And we're still seeing strength in things like shelter prices. I think everyone could be maybe overestimating how quickly those still might slow. But really, it comes down to those core non-shelter service prices. That's what Powell has focused us on. Those can stay persistently strong. Things like medical services, recreation, can definitely see a lot of upside there still.
Let's focus on medical inflation. It's such a large part of the inflation pie. What is your year-over-year forward on medical inflation? Dare I say it's double-digit?
I don't know if we'll quite get to double digits, but I think we can definitely see that component picking up. Not even necessarily in CPI data that we're going to get tomorrow, but I would look more for PPI data later in the week. That's what will matter for PCE inflation. inflation, but you can definitely see that running consistently at 5, maybe 6%, getting closer to double digits, maybe not quite there yet, though.
Veronica, you think this Federal Reserve can go further? You and a team over at Citigroup. The big question outstanding is ultimately to what extent the banking stress of the last month is a substitute for rate hikes. Veronica, why do you and the team think that what we've seen develop in the last month is contained, that the worst of it is done?
Yeah, I think we're seeing things stabilize now, and it's not that we wouldn't expect no impact on activity or inflation from tightening lending, and this probably does mean that lending standards tighten more and credit pulls back a bit more, but we should have already been expecting some of that, of course, from higher rates. And it's not that you're going to see it immediately. This is much more a second half of the year, end of the year type issue for the broader economy. And then for the Fed, the more near-term pressing issue is that you'll still have 3 months or so at least of pretty consistently strong inflation prints. And it seems hard to see a scenario where they're pausing, where we're still running core CPI at 0.5 every month.
Just to frame the current split, the divergence, you're well aware that the market is trading well below the Fed's dot for year end. Veronica, you're on the other side of this. You're well above the dot for year end. Just give me some numbers on that. Where do you see the terminal rate still for this Federal Reserve?
Yeah, we still have that terminal rate at 5.5 to 5.75. So that's a 25 basis point hike in May, another in June, another in July. And again, it comes down to this timing issue where we'll have tomorrow's CPI report before the May meeting. It's probably a lower bar for them to hike still in May. That's what the dots show. But before the June meeting, after the May meeting, we'll have 2 more CPI prints, and those look like they can stay consistently strong. And then at the June meeting, we'll have an update to projections for inflation, growth, and the dots. And it seems unlikely to us that the Fed will have to be revising higher their inflation forecast and then not still hiking. I think that keeps them going. The markets, of course, will just get there over time as we get consistently strong inflation data.
Veronica, this is really important. What you just said there is stop the show. You and Andrew are reaffirming a set of rate moves higher. So when you talk to Keith Horowitz, I know you're not on speaking terms, but how does your banking team at Citigroup adapt in, I guess the crisis is over, but adapt to flows in banking given your economic call? How do they adapt to that?
Yeah, I certainly don't want to speak for them, but I think, the system as a whole, we know that there are these issues, but it does seem like the Fed's facilities are working to control liquidity issues. And if things do stabilize, well, we know that the Fed has all of those other tools to deal with financial stability, but we do still have this price stability problem, and their only tool really to deal with inflation is rates.
So where does a money market fund go? I don't want you to be a rate strategist for Citigroup, but if I got the Hollenhorst Clark call, I think I'm looking at a money market fund of 5.5 or even higher percent, right?
Yeah, we certainly would have, short-term yields going higher again. You could see more deposit outflows, of course, but that was already happening even before the banking crisis. But that is what needs to happen. You need people to stop spending. You need credit to contract, and that's what slows the economy and brings down inflation.
John, I look at this, John, and besides our compliance officer just fell off the chair. Listening to that, if you get a Citigroup framework, what does that do to SOFR, LIBOR, all the Ira Jersey stuff? What does that do to somebody watching this or listening to this, to that money market choice, 5.65%? That's not 5%. That's a bigger percent. With a vengeance, you go there.
So, Veronica, as you pointed out, that would be a feature and not a bug of monetary policy. This is what they're trying to achieve. But given what we've seen develop in the last month, do you not think that would contribute to renewed stress in the financial system?
Yeah, that's certainly a risk, and we have seen some of those cracks show up at this point. But I think that for the Fed, at least, they would see all their other tools that they've used, the new facility, the discount window, as helping to control those financial stability issues. And it is a really tough situation. I'm not saying it's an easy thing for them. It could be an uncomfortable couple months here, but you do still, unfortunately, have an inflation issue.
Can we talk about what's developed in the labour market as well? On Friday, what we saw was a really resilient NFP, non-farm payrolls print. Once again, we've had a year of those, just upside surprise, upside surprise. But I don't think we've had a downside surprise since the March report, which came in early April of last year. Veronica, some people look back to the data of last week and they're looking for noise versus signal. Was the data before the payrolls print the noise or the signal? Because we had a string of misses going into that print.
Yeah, we had some softer ISM ratings. We had job openings that came down. Revisions to initial and continuing jobless claims that maybe those look a lot higher now and are trending a bit higher. I would say a lot of this data we should still take with somewhat of a grain of salt, especially that claims data. There looks like there's some seasonal pattern that didn't get worked out with some seasonal factor revisions, and I would say all of it is consistent with an economy that should be slowing, but certainly is not, headed off a cliff into an immediate recession. But we should be expecting, ISM services in a 50-55 range. We should be expecting job openings to be coming down. And I think, the labor market data, of course, on Friday, it is still a very strong labor market. The unemployment rate is still very low. It looked a lot like a 2019 kind of jobs print, but when you're running core inflation that's pretty consistently at 5%, you have to be worried that, a tight labor market like that will just add to the upside risk for inflation.
Hey, Veronica, this was great. As always, Veronica Clark there over at Citi, working alongside Andrew Hollenhorst with a call for Fed to take rates to 550. Tom, 555 to 575.
I'm glad Bramo's not here. Bramo would have fallen apart.
I think
she would have been into
Lisa
a second Bloody
would have
Mary.
jumped all over that one.
I mean, there's a whole group out there, and Lisa, I think, is very comfortable with this. I'll let her speak for herself, I believe, tomorrow when she gets back from the Bahamas. But the basic idea here, John, is simple. There's a group modeling out rate cuts. I didn't hear that there, I don't believe.
You don't hear it from the Fed. You don't hear it from Citigroup.
Yeah.
But Citi are taking rates further than the Fed are willing to take rates at the moment. I don't think the Fed is willing to come out at this point and make the call that the stress of the last month is contained and they've got a deeper understanding of how much the spillover, what it's actually going to look like. Citi's ultimately making that call. Citigroup is making the call that they think the spillover that you get from the last month will be limited. And for that reason, more weight will fall on the Federal Reserve to do more.
And the other thing here is Hollenhorst and Clark, they're going to need security to walk by the IMF building because they're miles away. Now, maybe they'll go there someday, but on a 5-year, 3% global GDP call, Citigroup seems miles away from that.
The controversial call from the IMF, Tom, is that they still believe that rates will return to pre-pandemic levels once we've dealt with this inflation story.
Yes.
I've heard tons of people say completely the opposite to that. For many reasons, the secular challenges that are going to basically drive rates higher than they were before.
And a great set of guests to join us here over the number of days, Tuesday through Friday in Washington. But, John, 3 shades there. They return to where they were. Let's call that the Powell 2%. Institutionally, Powell has to say we're going back to 2%. Above 2% is former Vice Chair Clarida, great friend of the show, writing in The Economist. Richard Clarida is saying, maybe not, and others as well. And then you got another group looking at an entirely new regime. And the debate is, John, where is that new regime? Is it 2.8%? Is it 3%? Dare I say, could it be higher?
I can tell you that in about 20 minutes from now, we'll catch up with Mike Schumacher of Wells Fargo, and we'll have that conversation with him after an amazing call from Citi, who still believe rates can get close to 6% over at the Federal Reserve, even with the threat of recession still lingering and that conversation continuing. Equity futures on the S&P 500 this morning, positive about 0.2%. Live from Washington through the week, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden will head to Ireland today for a long-awaited return to his ancestral home. His first stop is Belfast, Northern Ireland, where he'll meet with UK Prime Minister Rishi Sunak. He'll then travel to the Republic of Ireland to mark the 25th anniversary of the Good Friday Agreement and celebrate the recent Brexit deal. Senate Democrats want an investigation into undisclosed luxury trips that Supreme Court Justice Clarence Thomas accepted from a wealthy Republican donor. They've asked Chief Justice John Roberts to conduct a probe. The Senate Judiciary Committee, controlled by Democrats, will soon hold a hearing on the court's ethical standards.
In China, the government plans to require a security review of ChatGPT, I like bots. Now, providers of the generative artificial intelligence service must ensure content is accurate and neither discriminates nor endangers security. That casts uncertainty over AI bots unveiled by China's largest tech companies. In Switzerland, the government defended its role in the takeover of Credit Suisse. President Alain Berset told Parliament the intervention was needed to stop the collapse of the bank. Parliament didn't get a say in the deal, and the takeover cannot be derailed by legislation. And Warren Buffett is turning his focus back to Japan. Berkshire Hathaway has kicked off a yen bond sale, and Buffett told Nikkei that he plans to boost his investments in the country. Now, shares of Japan's major trading houses jumped after Buffett said he'd raise his holdings in them. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Going to keep rate World Cup. This is a 3
as the economic picture does.
The OK is getting ready to make this decision.
There's losses being allocated by the world system now, but we should keep in mind, if you just lower the interest rates back down, it won't solve the problem. What that means is that people will suffer from inflation. The dollar weakens, the inflation rate goes back up, and that hurts the poor the most. So I think there has to be a goal of finding a low inflation environment and dollar stability for the future.
David Malpass, the World Bank president. Someone needs to tell the IMF managing director, Tom, that when someone speaks, you can't keep saying, yeah, yeah, yeah. You know, who does that remind you of? Who does that remind you of?
Who could that be?
Who could that be? I wonder where she learned that.
The
Where do you think
way.
where do you think she learned that?
She's got this thing, too. She's got the hand like this.
I wonder if she got that from you. Let's check out the price action just quickly on the S&P 500. Equity futures shaping up as follows on the S&P. Slightly positive by 0.2% on the S&P 500. Yields lower by 3 basis points, 3.38 on a US 10-year. Just a note for Bloomberg Surveillance, Lisa is going to kick off a new surveillance newsletter today. I just want to point out where you can sign up. You can sign up at bloomberg.com/newsletters for daily insight from Bramo and the best moments from Bloomberg Surveillance. Very cool.
A tinge of gloom in it. Come on, it's got. If Lisa's driving
it's
this
got to have a flavour of gloom.
Have some worry
to it. It's got to. It's
the
going to be
report.
The daily anxiety.
Yeah.
You know?
8 pages, 12 pages?
I don't know. We'll find out.
It's killing.
I believe first edition today. So very cool.
Well, much more about that. Some of the digital stuff we're planning forward here. as well. This is an extremely important conversation because of the number of narratives in Washington. In all my years of doing this, the spring meetings of the IMF in Morocco later this year in October, there's 5, 6, it's like Howard Johnson's years ago. There are 28 flavors of narratives on where we are heading. A student of this is Douglas Redeker, managing partner, International Capital Strategies, but far more, and a former executive board member at the IMF and affiliated with Democratic politics in Washington. Doug, thank you so much for joining us. You were at Vassar a million years ago, and you're sitting there and they go, look, IMF, there's 2 narratives. What happened? Why do we have 14 narratives now?
Oh, look, I don't think you can start with the IMF of 20, 30, 40 years ago. I think it's a completely different institution. I think right now it has very little to do with the IMF and more to do with the world. So I guess we're better off that there's not one overwhelming crisis. If you go back to the Greek crisis, the Euro crisis, COVID, even Russia, Ukraine, those were dominant themes that squeezed everything else out of the room. I guess if you want to look at this through rose-colored glasses, the fact that we have multiple different narratives is probably better than we're all overwhelmed by a single one. That doesn't mean any single one of those is easy to resolve or the week is going to come out with anything that is concrete. But at least it's better than one thing that everybody's focused on because it's existential.
There is in the Financial Times today, and I've been searching for this for 3 years, folks, 3 years. What's the right phrase for the attitude we have from the great financial crisis? And Ruchir Sharma, ex-Morgan Stanley at the Rockefeller Foundation, absolutely nails it this morning, calling it the rescue culture. Is that what we're trapped in, where every institution goes, there can be no pain, there can be no angst, nobody can go out of business, every deposit's got to be covered? Do we have an international rescue culture?
We have a domestic international rescue culture. We have an international rescue culture, whether it's called rescue culture or an entitlement culture. Yeah, I think everybody assumes that there's a put, some form of put, whether that put is a central bank put or a fiscal authorities put or an IMF put. Everybody feels somewhat entitled. You've got me sounding much more pessimistic and negative than I thought I would be. But the fact of the matter is, yes.
Imagine if Bramo was here. Oh, my word. He'd be standing up walking out.
Do you think that sense of entitlement is misplaced?
Well, I guess it's well placed if, in the end, those authorities actually blink and write the checks, right? So if the game is, do we want to avoid another Lehman? If that's the moral hazard play, then fundamentally companies, companies, investors believe that when things get really bad, somebody, something, some institution is going to bail me out of the worst consequences. And to date, that's been a fairly solid bet. I don't think it's sustainable, but, not being sustainable can be 2 years, 20 years. I mean, there's a long time, right? In the long run, we're all dead.
Doug, what did we learn last month with regards to exactly this?
Well, I think it's too early to know what the long-term consequences are of SVB, Credit Suisse, et cetera. And by the way, I divide the two into totally different camps, but let's lump them together for the purposes of this, which is to say, yes, rather than letting unfettered capitalism, creative destruction play out, everything is systemic. You want to know what it is we learned? We learned that everything is systemic. So when SVB is suddenly systemic, it was the 16th largest bank in the country. It was not systemic by traditional metrics, but suddenly when it turns out that your Zoom call might not happen on Monday because Zoom was a big depositor at SVB, that's systemic. I don't know if that's how we contemplated systemic when we started this.
So if everything is now systemic, is it just implied that all deposits are insured?
Oh, look, I think that both Secretary Yellen and other authorities have gone very far to making sure that they send the message that implicitly, yes, but explicitly they don't have the congressionally mandated authority to say yes. So they're saying yes with a caveat, or they're saying no with an asterisk. Yes, but we can't say yes, but yeah, go to sleep at night thinking and knowing that your deposits are insured.
Doug, your work is to combine economics with law. Years ago it was Skadden Arps and all that, and Salomon Brothers as well. I am fascinated how you respond to an IMF 5-year call of economic gloom, of global GDP, 3% or less. Malpass came out at World Bank and it had a 2 handle on some form of present global growth. That's not Barack Obama's better America or better global. How did we get so negative so fast, so entrenched in our gloom?
So I have high regard for the economic teams at the bank and the fund. And there's a caveat coming. There's a but. The but is there's a certain amount of groupthink that trickles into a lot of this. And so you have desk economists who factor in their individual country projections into the regional, into the WEO or the GFSR. And what you end up with is not necessarily a holistic, strategically oriented 5-year forecast. It's almost bottoms up to the point where it's too bottoms up.
That's the single best discussion of that I've ever heard.
I'll take it one step too far, maybe. Is there space to make the accusation that some of these forecasts are political and not based on economics?
It depends on how you define political. And what I mean by that is I actually think there's a lot of people who are very technocratic, who keep their heads down, who have their pencils to their papers or the equivalent, and they are making their forecasts based on their best estimates without regard to politics. I think there are some other decisions at these institutions, program lending, certainly policy choices, that are highly politicized, probably more than ever before, or at least in the last several decades.
Well, listen, Doug, you're being way too polite. Kenneth Rogoff, who's got a nodding acquaintance with the International Monetary Fund, Ken's been borderline scathing that the IMF has become the World Bank. Do you agree?
Well, it hasn't become, but it's certainly trending in that direction. I think the current managing director of the IMF's instincts and experience are much more aligned with her experience at the World Bank. And I would make the counter-argument that David Malpass, in taking a harder line on lending to China, or in forcing China to the table to be more transparent and more conciliatory towards debt restructuring, has taken a more stingy, which would traditionally be seen as an IMF-style approach to some of the emergency lending coming out of COVID.
Can he come every day?
Well, as Tom might say, should we make some news here? Are you suggesting that Georgieva should be at the World Bank and Malpass should be at the IMF?
Oh, I would never make a suggestion about personnel at that level when those decisions have already been taken.
True.
Whether, in fact, they were the perfect fit for the job under the circumstances that we now have, let's say I think both of them have done an admirable job in their current positions, and I wish them the best of luck.
They were given a pandemic. We got to remember that.
Absolutely, and they inherited, as I say, this China card, which the IMF traditionally spent a lot of time, as it should, it's its mandate, dealing with debt restructuring, debt relief, debt issues in emerging markets and frontier markets, and that certainly is something that each one of them has handled in a different way.
Doug, this was great. We should do this more often.
We should
come down to DC just to catch up with Doug. Douglas Rediker there on the World Bank and the IMF, Tom.
But these are the themes that are out. This
week.
is what's beneath that.
Well, there are many themes, and I think that's the point Doug's making.
Yeah, but the back talk here is what people are talking about, which is Ken Rogoff's been really articulate about it. He wrote an essay, I believe it was for Project Syndicate, and he didn't mince words. John, this is an IMF that's taken on a pandemic mission very much like the World Bank.
Equity futures on the S&P 500 now, positive by about 0.2%. Coming up a little bit later on the programme, Mike Schumacher of Wells Fargo. Looking forward to that conversation with interest rates and yields a little bit lower by 3 basis points on a 10-year. From Washington, this is Bloomberg.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Just to add to my anxiety levels, which are already through the roof, I want to talk about the social consequences of this, because it seems like an environment where inflation is high, growth is slowing, the Fed is explicitly trying to boost unemployment. It seems like that is probably the worst environment for, your average person on the street. And it almost seems like the Fed's goals here, they're almost anti-American this point, or like anti the American dream, right? Like
Right.
housing
Well,
more expensive,
crushing the housing market.
crushing demand, crushing the labor force. Like, what are going to be the social consequences of central banks, having to do this in order to put a cap on price increases?
They're going to be severe. We're already seeing, of course, a backlash against free market, backlash against trade and globalization, even a backlash against technology, a backlash against, laissez-faire policies, because there has been a massive increase in income and wealth inequality. This is leading to populism of the extreme right and or of extreme left in many countries across the world, and authoritarian regimes becoming more popular across the board. It's a repeat of the 30s, literally.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's incredible how quick